A whopping 1.2% decline in the French index. Outperformance, however, in the UK. We'll see how much, Lizzie, that sticks at the opening trade.
Yeah, that French story, of course, comes down to luxury. We had the LVMH earnings, so there's a stock to watch at the open. Bad news across its goods, across countries, but especially China, especially its best unit. Remember, luxury stocks make up nearly 10% of the Euro Stoxx 50. You've got Kering down in the pre-market at 2. Mind Burberry as well. Adidas, one to watch, flagged by Joe Easton as we get towards the open. And ASML, of course, room for further weakness. We shall see. Anna.
Yeah, absolutely. So the market opened just seconds away then. Will we see any room for that positive story out of Adidas to cut through? Maybe not a day for that. The FTSE 100 then going its own way. We've seen a big drop in the pound. That on the back of the CPI number, which came in weaker. That could mean some positivity at the start of trade. In fact, we see that on the screen this morning. So the FTSE 100 doing its own thing, perhaps a bit of FX read across in the market there. More broadly, the stock 600 down by 0.3%. There will be a lot of focus on Paris. Critty, as you were saying, the LVMH story really stands out as something we need to focus on. To what extent will that take down others in the luxury sector? We saw that yesterday in the ADRs. It was the 10% drop in the LVMH ADR, but that was also echoed in some weakness, at least in the Kering ADR. So ongoing concern about China and what the demand will look like for luxury products. And even the CFO of LVMH saying they can't be sure exactly what kind of impact the latest stimulus measures will have. So broadly, we're still waiting then for the DAX to open up, still waiting for the CAC 40 to open up. We have a bit of weakness coming through on the IBEX, down 0.1%. I guess there's a lot of views and perhaps some changes of views being expressed in the markets then this morning, Critty, as we wait for an open in Paris.
A tale of two heavyweights, Anna, except it's really just one tale. When you talk about how this is showing up in the stock 600, your two biggest movers this morning, right off the bat, in terms of index contribution, is going to be LVMH and ASML. And we're already seeing that, a whopping 7% decline in those shares. Look, we're still waiting to Anna's point about that French index. That's going to be something we keep an eye on. But then we're also going to see how the ASML story is reflected in the Amsterdam index as well. Remember, that is going to be the heavyweight there. Right now, you are seeing down about 0.4%. But when you talk about the downside pressure, it is LVMH, it is ASML. We're throwing Hermes in there as well from a kind of stock mover perspective. But Anna, to your point, you are seeing outperformance in some of the kind of British names as well, or London listed names, I should say. SAP is going to be top of that list, not really getting the message from ASML. Those are two names that usually trade in line with each other.
Right, so the German SAP business, that tech name up by 1.3% this morning, as you see there, and some other heavyweights in London going higher. London does stand out, but Liz, you know, there's the FX effect in there, isn't there? And we saw FTSE futures change direction as a result of that CPI print and the big drop in the pound that we saw there. And we still don't have an opening price on the CAC or the DAX. So things taking a little time to open up this morning.
They are indeed, but as it stands, without the CAC and the DAX, you've got energy, the best performer in terms of the sectoral breakdown, higher 0.8%. Some of those London names in particular. You've got about a quarter of sectors in positive territory. Consumer products and services at the bottom of the basket, lower 2.9%. But as you say, we are still waiting for the CAC and the DAX to wake up and get going and process that impact of LVMH.
The Adidas story is going to be interesting as well. Does it kind of flow into this risk-off sentiment that we're seeing right now across the European indexes, or does it kind of rise above the rest of the gloom and doom? Of course, as we are waiting for some of those numbers to show up, I'm going to really emphasize the fact that from an index contribution perspective, it is those heavyweights, Anna, that are really, again, dragging the entire index down. The outperformers also, however, are showing up in the oil space. I thought this is interesting, given yesterday's session. You did see a lot of the commodity names down. You would think, given some of the numbers coming out of some of the miners in the metals space, that would also be the case today. You're seeing the exact opposite.
Well, oil, one area of stability in today's market, 74.47 is where we trade on Brent. I mean, the story has been a very volatile year for oil prices, as we talked about. The direction of travel in recent days has been weakness, unwinding of some of that geopolitical risk in the oil price. We dwelt on that a little yesterday, and added to that concerns around demand. But today, for a change, we take a breather on the oil story, it would seem, and we're pretty flat.
Yeah, so Israel saying that it's going to make its own decision on how to attack Iran, keeping open this possibility that energy infrastructure could be targeted. So as you say, you saw that 4% drop in oil yesterday, but now Brent on the front foot, higher 0.3%, $74 a barrel.
Well, in the meantime, as we've been speaking, we're still awaiting the French index to properly open. The DAX, however, it's opened unchanged. It looks like it's still digesting some of the cross currents we're seeing in this equity market. In the meantime, let's talk about those regional cross currents. We've talked about outperformance in the periphery relative to the core. We asked Bilal Hafeez, the CEO over at Macro Hive, about that very dynamic and whether or not that actually continues. Take a listen to what he had to say.
Some of the factors that are driving the strength in the peripheral Europe is things like tourism. There's certain catch-up consumer demand, which isn't necessarily linked to Germany. And moreover, Germany's weakness is specific to its own sectors that are doing poorly, in particular the auto sector, which is not related to what happens in Spain and Italy. So I do think the periphery could continue to outperform relative to Germany, at least for the next 3 to 6 months. So there could be this period where they don't catch down to Germany.
Macro Hive's Bilal Hafeez speaking to us yesterday about that difference between what the periphery is doing and what Germany's doing, whether Germany can be the drag. This morning, when it comes to the drag in the equity markets, it is all about France, and that's where we're seeing the most pain. The CAC is officially open by about 1% lower. You are, of course, seeing the luxury names really weighing down, as expected, on that French index. It is the underperformer of the region this morning. Let's get a little bit more perspective. Maximilian Uller, head of European Equity and Cross-Asset Strategy over at Deutsche Bank, joins us around the table. You picked a good day to join us. The markets are doing their thing. Walk us through what seems to be the theme of the morning, which is China is the Achilles heel for some of these heavyweights. It's getting priced in as soon as we get these numbers. Is this a one-off?
So I think there are basically two things that really strike, right? That's yesterday's ASML and LVMH numbers, and they're highlighting consumer weakness in China. We think we are far from a recovery there. So we're not yet saying, even though we see the stimulus, that we should be buying into that sector. Too early. We think first have a recovery in asset prices and then in consumer sentiment and probably a lot later in manufacturing. So that's a theme I think will continue for now. And semis have been weak, and I still think that estimates for next year's earnings are a lot too high. So if you look at sell-side estimates for next year's earnings in the tech space, it's plus 28%. So I think the buy side is actually a lot closer to reality than sell side. So I think sell side needs to still decrease their estimates for next year across the board.
It's not a very happy message at 8 a.m. in the morning. But give us then, and I'm going to flip this on its head because there's plenty of the downside to cover. Is there a bull case in Europe right now?
Absolutely. So I think what's the great news is that those two things are the main drag on markets, and that's been the two biggest companies, or two of the 5 biggest companies in Europe, but they're 2 out of 600 in the stock 600, right? So there's still a lot of other companies going to report with better fundamentals, and we think that earnings will come in 5% higher than people expect. So 5% higher than consensus estimate of minus 1% for Q3. And Q4 even better. Because what's interesting is, yes, the situation is quite challenging, but estimates, apart from semis and tech, are actually quite low. So very depressed. If you look at Q4, we think actually beats are going to be a lot higher. H2 of this year, in our view, is going to be pretty much stable, slightly better than H1. But remember that H2 of last year was really horrible. So we had double-digit negative earnings growth H2 last year. So double-digit positive numbers this year, from a base effect, are quite likely.
So this is really interesting because we started pretty rightly pointing to some of the negativity in markets. It's very obvious this week around the ASML story, LVMH story, all of that front of mind for investors. And yet you have quite a positive outlook for 2025. And it's based on a sort of wave of themes picking up through the year. So starting with rate-sensitive stocks, then consumer spending, then a recovery in manufacturing. So if we're looking at tech, and right now, if that is part of the manufacturing wave later on, we're looking in the wrong place, you think, for where an upturn starts?
Yeah, I'll be very selective in those sector choices. We are overweight those rate-sensitive sectors you mentioned, so real estate, staples as a bond proxy. Construction, we think, is going to do a great job. We just downgraded utilities after the great outperformance. Next up is consumer. In my view, there are three things that you need for the consumer in Europe to be spending more. That's lower rates. We're in the midst of a rate cutting cycle. We think ECB will cut over 1% until April. You need higher wages. If you look at Germany, wage growth is 6%. Despite all this negative news, wage growth is pretty solid. We're expecting more than 3% next year for the Eurozone. So wage growth, check, right? You need higher wages to be spending more. And then third is consumer confidence. And although it might not feel like that, consumer confidence has been picking up for 2 years in Europe already and is back to normal. Now, at the same time, savings rate is around 15%, which is the highest outside of COVID. So we think just by savings rates coming back down, we'll have a consumer spree in Europe.
Okay, so you think there's room for the consumer to step up then in Europe, and part of it, as you say there, due to real wages. But in terms of, Max, in terms of that real wages story, it seems we've been sitting on that for quite a while, actually. But psychologically, it seems to take a while to cut through. You still hear talk of cost of living crisis in various parts of Europe, even though inflation has really faded and wages are much higher in many places, as you point out. But prices are still elevated versus pre-COVID. If people are waiting for them to go back down again, they'll be waiting a long time. But it seems psychologically it takes a long time for the consumers to buy into this trend that you describe.
Yeah, right. It takes a long time, right? And we think we're now at this turning point because what's happening now is rate cuts. And if you have 4% and you get on your deposit, right, you probably put more in your savings account. If that comes down to 2%, probably going to spend a little bit more, but I agree. So it takes longer than we expected, but don't, mistake real wages for nominal wages. Nominal wages have been growing for a while. Real wages have just been picking up over the last 2 quarters. So that's a trend that's just emerging now. Agreed, takes longer than expected, but happening.
Maximilian, let me ask you about your favourite index, the FTSE, having a good old day today off the back of those CPI numbers. Is there anything that Chancellor Rachel Reeves could do on October the 30th that would change your mind about that?
Actually, I think there's plenty of reasons that make me more positive about the FTSE than the rest of Europe. And you've seen today's market move, right? You have this great volatility in Europe ex-UK and UK stable again. So we have our preferred sectors are very well represented in the FTSE. We think political risk in the UK is actually lower than in the rest of Europe. If you compare the budget problems that the UK is having, we have bigger problems in France. We have similar problems for a different reason in Europe and Germany. So I think, relatively speaking, the FTSE is the most attractive. Higher staples exposure, zero tech, very low luxury exposure. So I think sector performance, political risk, plus CPI numbers yesterday, for example, giving a good background.
What about the political risk in the US? Pretty eager to find out how to trade it and when you can trade it. I'm thinking potentially about the impact on luxury names of tariffs. Could we see them there?
Certainly can. If I may repeat that, probably the FTSE is going to be the one most exempt from those tariffs, because usually those are targeted at the Eurozone, right? So again, maybe one reason to be more positive on FTSE, we'll have those tariffs if Trump wins. You had the interview yesterday on Bloomberg, right? He's been mentioning tariffs again and again and again. We don't think it's a game changer, but it's certainly not good news.
You mentioned, I'm going to take it away from tariffs for a moment and bring it right back to a point you made earlier on construction. You said you were positive on construction, and there's really only a bull case I've heard around the periphery where so much of that construction is funded by fiscal spend from governments. Is that the case around construction?
It's really residential construction. That's, I think, one big driver, right? If you look at Germany, for example, 10% of German GDP is construction. And that's been coming down over the last two years in our estimates by 15%. So you could say 1.5% of GDP negative growth in Germany, for example, is due to construction. Now that's been coming down also because of higher rates. At those rates levels, people don't want to be building houses because buying something or renting something is cheaper. That dynamic changes a lot over the coming month. So they already have high order books, and with lower rates, those order books are probably going to be even bigger, leading to more profits.
Let's see if that sticks. It certainly doesn't look like it in the markets at the moment, but maybe things will change. Maximilian Uller, head of European Equity and Cross-Asset Strategy over at Deutsche Bank, joining us this morning. I get the fun task of doing the Sensational Six today, and the market moves around. Some of these names are indeed sensational. Take a look at LVMH, take a look at ASML, brutal numbers there. A whopping 6% decline on LVMH, 4% for ASML. Novo Nordisk having a good day. They're looking at its peers and really smiling, higher by about 0.8%. One of your biggest index contributors to the upside, but really not stemming the losses you're seeing in LVMH and ASML. I think it's just worth going through some of the other pain that we're seeing in this market this morning. Let's get a read on that with Joe Easton from our equities team. Joe.
So brutal really is a good word to describe it this morning, Critty. We're seeing all of these luxury stocks dropping. LVMH was down 7.5% at the open. You had to go back to the COVID outbreak of 2020 to see a closing price as sharply down as that for LVMH. And we're also seeing peers like Kering coming down. Bear in mind, this stock already down around 40% this year, down another 5%. Hermes in France as well, and then spreading it over to Switzerland. We're seeing Richemont, one of the more defensive companies in the space, dropping as well. And we are seeing a broader read across into other countries as well in terms of some luxury movers. We had some decliners over in, well, here in London, Burberry down 4%, Moncler in Italy, and we mentioned the drink stocks as well. Remy Cointreau falling 2%. That one hit. We also saw Diageo lower. Pernod Ricard fell as well. And finally, over in Italy, bear in mind, Salvatore Ferragamo, they did actually have their own little profit warning yesterday, kind of wiped out by the LVMH news, but really adding to the gloom in that one today. And we will flip over and have a look at some of the UK shares. Well, first of all, here are the semis. We can't forget about those. Now, this is also pretty striking. ASML fell 15% yesterday, and it's down another 4% today, down 19% on 2 days, the biggest two-day decline since 2002 for that stock. So really massive moves on there, and seeing the read-through. Once again, these shares declining, adding to the losses we saw late yesterday. Some had expected a bit of a rebound, but BE Semi, VET, Soitec, all of those names coming down. Then we will go to the UK because this one's standing out given the CPI data, and we are seeing positivity in this market. One of the few markets seeing gain today. Taylor Wimpey, mortgage rates coming down potentially with what we all want to see, and that is boosting the home builders. Lloyd's getting a bit of an uptick, although it is unclear whether the rates coming down is actually good or bad for banks these days. In utility, Centrica coming up, given the bond yield relationship, and the high street retailer next getting a little uptick as well. Will we see another Bank of England rate cut next month? We'll have to wait and see, but we are seeing positivity on that. Then in terms of earnings today, we have got Adidas. Now, Adidas, everyone said that was good, but I think the LVMH news really just wiping out all the positivity in fashion stocks today. Premier Inn, though, doing well. A bit of green on the screen, finally. Well, that's what we like to see in the UK for the hotelier, the best performer in Europe today, only up 2%, kind of telling us how bad the market is at looking at the morning. And we had some profit warnings. One was Rexall, we mentioned in stocks to watch. That's electrical components and Just Eat takeaway. The Americans not buying enough takeaways, according to their report. That's over in the Amsterdam Exchange. Finally, we're going to take a look at L'Oreal, because this one getting absolutely slammed because JP Morgan went underweight. That was down around 8% at the open. It's come back up a little bit now. JP Morgan underweight, but also LVMH really hitting every stock in that sector as well. So that one declining, adding to the woes following JP Morgan going underweight L'Oreal this morning.
Joe, thank you. Joe Easton with a very busy day from our equities team, running us through some of the stories from yesterday evening that linger on into this morning and some of the new news we need to factor in. And some of that comes from the luxury space, of course. Coming up, LVMH shares falling then, as Joe's been telling us, after reporting a slump in sales as the luxury industry's biggest player is hammered by a drop in demand from Chinese consumers. We will dig into the details. We'll get an update from Paris shortly. This is Bloomberg.
Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week More than what you need to know, it's what you need to think about.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
There is this real momentum from Wall Street.
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
As we spend some time here on the broader presidential race,
Let's focus in on European politics.
Makes you wonder how politics might play out.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
Welcome back to the opening trade. Well, this is the picture across European equity markets right now. We see some divergence. The FTSE 100 then benefiting from the weakness in the pound, and so that stands out to the upside, up by 0.7%. Elsewhere, the CAC 40 really under pressure, down by 1%. The DAX down 0.3%. To sum up some of the headwinds that we have being thrown at these markets, let's just have a look at some of the themes we're dealing with right now, and many of them coming to us from China, but they take different forms. In the luxury space, we seem to have some consumer stocks that are struggling, and the luxury side of things very much in focus there. LVMH is the poster child for that right now. That's weighing on Kering and others, though. We also have geopolitics playing in, and the difficulties for ASML and the like of selling into the Chinese market. Perhaps that's something we'll learn more about later on today when we get that investor call from ASML. It really shocked the market yesterday with its update. Came in earlier than anticipated, but certainly China and an understanding of the geopolitics, one of the things we want to find out from ASML. And then China crosswinds also hurting the auto sector, although the overnight news really more around Stellantis in North America. But we do have, of course, this ongoing focus on what China and relationships with China and the geopolitics as it plays out is doing some of these consumer brands here in Europe. Let us focus on the first of those, and that's the luxury side. LVMH shares have slumped after the French luxury giant reported a fall in sales of fashion and leather goods for the first time since the pandemic. For more, we're joined now by Bloomberg's Caroline Conan, who's in Paris. Caroline, take us through then how bad things are getting for LVMH.
After years of shine for this luxury sector, clearly even the biggest brands such as Louis Vuitton, Christian Dior are not resisting the slowdown. The overall revenue at LVMH in the third quarter is down 3%. They missed basically on every single unit. Let's talk first about their biggest one, fashion and leather, which of course includes Louis Vuitton, down 5%. That's much worse than expected. It's actually the first actual drop since the pandemic. The aspirational consumer clearly is not back, and the Chinese, of course, is still very reluctant to spend given the problems they have there, especially in the property sector. And the stimulus that we've seen recently in China is clearly not yet reflected in these third quarter numbers. Asia, excluding Japan, is down 16% in the third quarter, and that region alone is 1/3 of LVMH global sales. So that kind of gives you an idea of the impact it can have on LVMH globally. We heard from the CFO, Guillaume, last night in the analyst call, who actually said that consumer confidence in mainland China is now at an all-time low reached during COVID. COVID. Japan also was impacted by the stronger yen. Chinese consumers not going to Japan to do their luxury shopping. Things are not getting better in other divisions of LVMH. Obviously, watches and jewelry down 4%, even though Chaumet was actually the maker of the Olympic medal. So they had a lot of visibility, of course, in the third quarter. And it's not only China, it's also the US. US consumers, analysts were expecting a pickup in the US. In fact, LVMH didn't grow at all in the third quarter in the US. US consumers buying less champagne, less cognac, and cognac producers, of course, things are not going to get any better there given the new tariffs from China on cognac producers.
All right, Bloomberg's Caroline Connin in Paris, we thank you. And I want to continue this China theme and take it to ASML, which is compounding yesterday's losses off the back of those results. Dropped early, of course, yesterday. We're expecting them this morning, but down 17% in 2 days now, having opened lower this morning, down 5% just this morning. They had this tepid outlook, sparking a global rout in the sector yesterday. Losses of more than $420 billion. But let's get more info now from Bloomberg's Sarah Jacobs in Amsterdam. Sarah, how much is this story about tariffs? How much is it about uneven demand? And most importantly, when are we going to find out whether it was because they got this early result from fat fingers or the intern?
Good morning. Yes, you're right. ASML published their third quarter earnings a day earlier. We were expecting it to hit at 7 a.m. this morning, but it came in last evening. The company cited a technical error for yesterday. In terms of results, yes, bookings missed estimates. The bookings came in about, the orders came in about half of what analysts had anticipated. They cut guidance for next year for net sales and gross margin. So a surprising slowdown for Europe's most valuable tech company. ASML CEO said it appears, in a statement yesterday, he said it appears that the recovery is more gradual than they had expected, that it will continue into 2025, leading to customers' cautiousness. So we'll have to hear more about why this happened and what it looks like over the next year during the earnings call at 3 p.m. today.
All right, so Sarah, I'm going to put you on the spot here. What else are we looking for? Is this kind of the worst that it could get for ASML, or is there more pain to come?
Well, we'll have to see what they say. Of course, pointing out that analysts are also investors are looking at the November 14th day, which is the ASML's Investor Day, where they are going to talk about long-term scenarios for, lithography demand and, their outlook as well. So in terms of how things go from there, that's another important day for the company. But of course, based on what they said yesterday, weakness in ASML's orders often signals struggles for the entire or the wider chip sector. ASML is seen as a bellwether of sorts in the chip industry because its machines are used to make, the most advanced chips, and it has clients like TSMC and Intel. So it's a big miss is a signal that, the chip industry's weakness is possibly set to continue.
Yeah. Certainly something we're going to be keeping a close eye on. The ripple effects from China certainly getting broader and broader. Bloomberg's Sarah Jacob joining us out of Amsterdam. We thank you so much for giving us that crucial insight on those ASML numbers. Coming up, with the global easing cycle firmly underway, AIB's Colin Hunt is going to be giving us his take on bank profitability and more. That conversation next. Stick with us. This is Bloomberg.
I've seen firsthand how some fashion businesses make women feel. And I think there's one thing, you know, being really vocal and being an Instagram activist and talking about something, there's a difference than putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was like deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends, and I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, you know, created, when you're solving a problem that's real for you and therefore real for the consumer.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space. That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Or other authorities
could face bigger challenges next.
Fed was going to keep rating World Cup. This is a 3
as the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
This is the opening trade. We're 30 minutes into today's session. You're looking at the Stock 600 lower 0.25% this morning. The underperformer is the CAC 40, lower 0.7%. What's weighing on that is luxury. LVMH lower more than 5% this morning, and that hitting names across the sector. Kering, Burberry, Hermes even this morning. But also we're seeing the SML impact. That stock down even more this morning off the back of their earnings yesterday. 4.2% down this morning.
Yeah, really incredible moves in ASML, aren't they, over the 2-day period? Because after that 16% drop yesterday, you wondered how much of that was sort of in panic at the early release and how much of that would be sustained into today's session. Well, the answer is all of it and then some. So we'll wait to see what details we get in the call. I think that's going to be really interesting, that investor call later. What exactly is it? Who exactly is it that's holding off on orders? Which sector of their business is coming under pressure? And then we can establish really the read across into other businesses.
I don't even know which one is worse here, because if we're kind of pointing the finger at China for both of them, for LVMH, it is a Chinese consumer story. It's a broader kind of demographic that they're trying to reach or that they're trying to encourage. For ASML, those machines are very expensive. It's a handful of customers that even if they decrease a couple of orders, has a pretty material impact to their business. So it's an interesting way to talk about who is actually making this difference. It's not the only market move we're watching. The UK assets are moving quite a bit as well, which is where we started our program on CPI, 129 handle on cable.
Yeah, absolutely. So the weakness in the pound actually supporting the FTSE 100, of course. You see that often. And the FTSE is up by 0.7%, standing out to the upside. Although I should say the IBEX over in Spain also a little stronger this morning. Something else that is stronger is banking stocks out of Italy, which is of interest when we go to our next conversation. Bloomberg understands Italy's government plans to raise 3.5 billion euros by tapping the country's banks and insurers to help finance the budget. Prime Minister Giorgia Meloni says the money raised would be allocated to healthcare and the most vulnerable. Joining us now with an update, Bloomberg's Alessandro Migliaccio, who's been covering the budget story out of Italy for us. How big is Meloni's budget plan then? What does it cover here?
So late last night, the cabinet passed the budget plan, which then has to go to the EU, and then will go to the Italian parliament for approval. And from what they told us, and here's the thing, they didn't tell us much. It's a bit unclear, but it seems like they said 30 billion gross. All right, so that 30 billion gross covers a lot of different things. We're talking about aid to families. We're talking about huge tax cuts on wages, on the tax wedge. We're talking about healthcare, as you mentioned before. Lots and lots of things. And they didn't really tell us how they're going to pay for it. They did tell us one thing. They told us banks will play a role in paying for it. And it's what they're paying for is about 3.5 billion. Now, you can see that it's 3.5 billion out of 30. I guess they got away easy is one way to put it. You know, they will be paying a bit more, but it looks like it's 3.5 billion over 2 years. We've heard from sources, and it's really not that much to cover that huge budget. So I think compared to what Meloni had said about banks, how they've been profiting from high interest rates and they need to contribute more, they're not contributing that much. So in a way, it went well for banks.
In terms of some of those banks, it looks like 3.5 billion euros over 2 years. Doesn't seem like that much. Can you just put those numbers into context for us?
Right. So yes, it's this very weird number for us. I mean, as we were looking at it with analysts and we're talking to some economists, and it looks like it's going to be in deferred tax assets as well. So that's interesting. That means that I guess they will pay a bit more now and over 2 years again. So we're looking at maybe 1.7 billion in 2025 and then another 1.75 in 2026. Really not that much. And if it's deferred tax assets, as we were told, the government has not yet confirmed this, then, you know, they pay a bit more now, but in the long run, they'll pay less going forward. So again, they're not really paying this money. So the banks, you know, last year, the government was really trying to get the banks to pay. It looks like they haven't found a legal solution that the banks you know, would fight any option, anything that the government does to strike just the banks. Legally would be complicated. They've never really succeeded in the past. So that's the reason why they're unable to do what they're trying to do. But it'll be interesting to see. There's a press conference today at 11, so we'll be asking those questions, you know, to the Italian finance minister.
All right, Bloomberg's Alessandra Migliaccio, we thank you for making sense of the few details we have got from Giorgia Meloni there. And I want to continue this conversation on the impact of European budgets on European banks. We can talk now to Colin Hunt, CEO of the Irish bank group AIB Group. Lovely to have you with us in the studio, Colin. We got the Irish budget at the start of the month. The sale of AIB shares, giving the government more cash for infrastructure upgrades. The obvious question is, are there going to be more state share sales in 2025?
Well, we've seen quite a significant decline in the government's shareholding in AIB over the course of the past number of years. They started with an IPO process in 2017, then paused and resumed using ABBs, DBBs and a trading plan to reduce the shareholding in the company, and it's come from 71% down to just less than 21% over the course of the past almost 3 years. We very much welcome the fact that we've seen the monies from AIB that we've generated this year for the state, about €3 billion, being ring-fenced for critical infrastructure development in housing, in water and in electricity. And look, my job is to ensure, along with my colleagues, that there's a strong investment proposition in the market when the government decides to transact. But ultimately, it's the government's decision. It is, though, within the bounds of possibility that we will see the Irish government exiting the share register in calendar 25.
But do we have more detail on the kind of time frame for that exit? Well,
the government's trading plan is running. That clips at about 1% a month. There is this year we did a directed buyback on foot of our annual results, which we announced at the start of March. We did a further directed buyback, 1.5 billion in total, when we announced our interims. And let's wait and see what we have to say when we get to announce our full year results. But I'm concentrating on closing out 24 for the moment. Let's wait and see how we end the year, and then very much look forward to bringing that news to market in the opening weeks, probably of March.
Okay, so it's in the bounds of possibility that we see the government reduce that stake more than in 2025. Colin, this story goes back such a long way, doesn't it? You know, we remember when governments around Europe were taking stakes in banks, and now we've seen, in quite short order, governments in Ireland, the UK, Germany, the Netherlands, Greece, all selling off their stakes. Obviously, higher interest rates, more profitability for the banking sector help there. Are you surprised how long it has taken us to move on from the financial crisis in the sense of government ownership of banks across Europe?
I'm not overly surprised, to be honest with you, because the scale of damage done to the financial system during the global financial crisis was so great that it required a long period of time to correct the damage. So at AIB, we've been focused on reducing our non-performing exposures, dealing with legacy issues, cleaning up our loan book, building a better, stronger bank, building a better balance sheet. And we've done that. And now we have a very, very strong investment proposition to bring to the market, and the government is making use of that in reducing its exposures. But I'm not overly surprised it's taken this long.
Okay, well, one of the other legacies of the financial crisis is a cap on bonuses in some parts of Europe. Now, the UK's got rid of that, but much of it still remains. And I know you've spoken in the past about it having an impact on your ability to seek and retain talent. Are you still seeing it having an impact on departures?
Yes, it is, yeah.
Especially to the UK, perhaps?
No, within Ireland, largely, because the restrictions as they are in Ireland, in terms of the bonus restrictions, apply to the bailed-out institutions rather than the broader industry. But we are seeing an ongoing impact of it. And if you have a situation where even somebody in their early career looks at opportunities of joining a company with unrestricted remuneration and a company with restricted remuneration, it's not unreasonable to expect that individual to make a decision that creates greater earning opportunities for them over the medium term. But it does create an uneven playing field, and certainly we have to work extra hard to ensure that our employee value proposition is strong in the market to recruit and retain.
So have you been talking to the finance department? Have they given you any hints that salary cap could be lifted now that their stake is lower?
Well, I don't engage in those conversations with the Department of Finance. That is a matter for the board of AIB, and the board of AIB has been in correspondence, which is public, with the government over the course of the past 15 months or so on this topic. But my focus is very much on ensuring the bank is delivering for all its stakeholders and as well run as possible.
Well, speaking of things going on and conversations happening at the finance department, talk to us about taxes, the really juicy stuff here. I believe in the last 24 hours, a proposal has been made in Ireland to have even more tax-friendly policies for businesses. Certainly something that I think a lot of corporates around the world are kind of perking their ears up at, given what you're hearing in France, the UK, and potentially in the United States in a couple of months. Is that going to show up in your bottom line, any of those kind of business-friendly proposals that they have?
Well, I think that Ireland has been a very attractive destination for foreign direct investment, and certainly taxation has played a role, but it's only played a role, and there are other dimensions to Ireland's attractions as a destination for foreign direct investment, including open, unfettered access to the largest single market in the world, in the European Union, and certainly the pro-business approach of government, the stability of government policy, and the taxation arrangements have proved beneficial in seeking to attract foreign direct investment, particularly from the United States. And we now have a very, very nice industrial cluster built in technology and digital.
The poster child of that dynamic that you're just talking about in terms of attracting that foreign direct investment seems to be Apple. I won't ask you about Apple specifically, but you made that comment that Ireland is the gateway to the European Union. In the last month or so, you've had a top court at the EU say, well, actually, Apple owes back taxes to Ireland. So that kind of tax haven, that business-friendly policy, maybe this didn't exist. Do you think that changes the view for corporates like Apple who were looking at Ireland and are maybe reconsidering?
Well, I think in this particular case, this relates to legacy taxation issues. This court case was running for the best part of 10 years. During that 10 years, we've seen an extraordinary performance in terms of FDI flows into Ireland. So certainly, as the court case was running, there was no impact, no detrimental impact on those flows. Ireland is fully compliant with the OECD BEPS. We've recently raised our corporation tax rate on large corporates from 12.5% to 15%. But I do think that the key thing here is policy stability, policy certainty, and that genuine pro-business approach.
So that's the Irish side of things and what's in control of the Irish government. But then there's the other factors as well, which is that the corporate tax rate, capital gains tax rate, among other not business-friendly kind of circumstances are existing in France, certainly potentially in the UK, windfall taxes in the periphery, not to mention the election in the States. Do you see this idea that were we to hypothetically see a higher tax rate show up in the United States, you would see even more flows into Ireland?
Well, the indications are at the moment that we are going to see a lower flow going forward than we've had in the past, and that's not necessarily problematic, given the fact that we've seen a 17% increase in employment in Ireland since the 1st of January 2020. So not only have we recouped all those COVID losses, but we've actually moved well beyond an extraordinary performance in terms of employment growth, and the economy is operating at pretty close to full capacity. But that said, leaving aside the taxation issue, which is an important feature, there are multiple factors in driving Ireland's attractions as a location for FDI, not least, as I said already, open, unfettered access to the European single market, the only English-speaking common law country that offers that.
Yeah, and Colin, that's interesting. Takes us to a conversation perhaps about commercial real estate and your exposure there in Ireland. That's one area that maybe has been supported by some of these big US multinationals locating there. Do you see, but some people are nervous in many geographies about CRE post-COVID. Are you nervous about the commercial real estate picture that you see and your exposure to that?
Well, I would have been more nervous during the rapid tightening phase of monetary policy, because it's going to have an impact on yields, and as yields go up, underlying valuations are going to come down. And certainly we took a forward-looking, cautious approach to our CRE lending in the past number of years. We haven't lent into the United States. Our heaviest exposures are obviously in Ireland. We have some exposures here in the United Kingdom. Very conservative underwriting standards. I suppose the shadow of the GFC and the shadow of AIB's performance during the GFC is still very much being felt. So we don't lend LTVs in CRE above 60%. And what we've done is we've taken a very conservative approach to our provisioning in this space. And looking at 2023, I think we took a provision in CRE of about 280 million, the bulk of which came from a post-model adjustment. So it wasn't a specific case or a specific troubled case, it was our general view on the marketplace. So we're very strongly provisioned. In fact, in the first half of this year, we saw some stage 2 cases moving back to stage 1.
Okay, interesting stuff, Colin. Thank you very much. Thanks for joining us this morning. Well, he passed through London. Colin Hunt, the CEO of the Irish bank AIB Group. Coming up on the programme, Donald Trump dismisses criticism of his tariff plans just 3 weeks out from the US election. More from our interview with the Republican presidential nominee and former president. That's next. This is Bloomberg.
What legacy I would love to leave is to make sure that in my village I have infrastructure. So long when I'm gone, things are still working, then I have done my job. And if some people get inspired through my work and then try to engage themselves for their community and create something that is inspiring for everyone, I will be happy.
What's the best piece of advice you would give to someone young who wants to make a difference actually in this world? In architecture or with something else?
Wow, I'm not the right one to just do that.
I think you are.
Yeah, but with the pressure you have, and then you try to be the good one, the fancy guy, the intellectual one, I have no advice then to believe in yourself and really work hard. You know, when I started, no one would have imagined that I will be able to see my name connected with Aga Khan or Pritzker or sitting at Bloomberg to talk about sustainability, about future of sales. No, myself 5 years ago, if you told me that, I will say no. I will never imagine. So I will encourage everyone to believe in what you're doing and not try to run after the newest of the newest. Just be consistent. Just work on things that matters for you. Really, at the long term, it pays.
I had 4 years no inflation. I had 4 years no inflation.
But that was when you had much.
I had 4 years. It's better than that. And Biden, who has no idea where the hell he is, okay? Biden went 2 years with no inflation because he inherited from me. And then they started spending money like drunken sailors. They spent so much money. It was so ridiculous, the money they were spending. They were spending on the Green New Scam. The Green New Scam, the Green New Deal. You know, it was conceived of by AOC +3. She never even studied the environment in college. She went to a nice college. She came out, she just said, the Green New Scam. She just named all these things.
But President Trump, the issue at the moment, the markets are looking at the fact you are making all these promises. Latest one was car loans. You're flooding the thing with giving giveaways.
But we're going to grow.
I was actually quite kind to you. I used 7 trillion. The upper estimate is 15 trillion. People like the Wall Street Journal, who's hardly a communist organization,
yeah, but you don't know.
They have criticized you on this as well. You are running up enormous debt.
What does the Wall Street Journal know? I'm meeting with them tomorrow. What does the Wall Street Journal know? They've been wrong about everything. So have you, by the way. You've been wrong about
You're trying to turn this. You're trying to turn this.
You've been wrong.
No, you're trying to turn this into debate. There are business people. There are business
you're wrong.
people.
You've been wrong all your life on this stuff. You've been wrong. Let me tell you about currency. You're going jump in a lot of different subjects.
Whilst you're sticking to the subject very closely.
Let's stick to reserve currency. That's where you start, right? The reserve currency is under threat because you have Iran, you have Russia, you have China. China's the one that you have to worry about because they want it.
Yeah.
They want to have the yuan be the thing of power. So here's what I'm doing. Again, I hate to go back to it. If somebody says, and I know countries want to get out because they don't respect our leadership, they look at this guy, they say, you got to be kidding, and she's worse than him. By the way, I never thought I'd say this. She is not as smart as Biden, if you can believe. This is not what, we had 4 years of this lunacy, and we can't have it anymore. We're not going to have a country left. Okay, currency, very important.
Yes.
And if you want to go to third world, status, lose your reserve currency. We have to have that. We cannot lose it. If you you'll go to third world status in this country because you take a look at the way things are running. If a country tells me, sir, we like you very much, but we're going to no longer adhere to being in the reserve currency. We're not going to salute the dollar anymore. I'll say that's okay. And you're going to pay a 100% tariff on everything you sell into the United States. And we love your product. I hope you sell a lot of it into the United States, but you're going to pay 100% tariff. He will then follow it up by saying, sir, it would be an honor to stay with the reserve currency. That will be like just playing. That's not even chess, that's checkers.
Republican presidential candidate and former President Donald Trump speaking with our editor-in-chief, John Micklethwaite. And I think there was a lot that happened in that discussion, but I think the key takeaway for me has been that he's sticking really to this plan that there is a deficit that's running in the United States right now. The way to fund it, or the way to close that gap in the face of tax cuts that he wants to extend into a potential second term, is tariffs, and that's the answer to that. The issue here is that it's all on the condition of bringing back manufacturing to the United States, which is why his 15% corporate tax rate is contingent on if you produce in the United States, just as tariffs are contingent on your exposure there. Does that help solve the U.S. budget problems is going to be a key question.
Yeah, absolutely. I mean, he believes in that strategy. Many economists point to the risks of retaliation, point to all kinds of other risk factors, the risk around higher inflation. Interestingly, he brought up a lot of subjects just in that short clip we showed there, and there were many more of them, but we have a nice explainer on the Bloomberg terminal about some of his remarks on the economy and sort of taking the longer view, giving them some context that they needed around tariffs, around budget deficits, all kinds of policy areas that he referenced there. But it's interesting to think about where retaliation might happen in Europe then, Lizzie. If we did see further tariffs on European product, just cast your mind back to Trump 1.0, and we saw Europe aiming at things like Harley-Davidson and Levi's. And you can see from our reporting overnight that Europe is once again drawing up lists of which companies it might target.
Yeah, and it could be a bigger impact here between the US-EU relationship than the US-China relationship, as our guest from RAND said earlier.
Okay, let's talk about where we are on the banking sector right now. The most volatile quarter since the pandemic delivered a windfall to Wall Street's trading desks. The likes of Goldman, Bank of America, Citi and JP Morgan all posted equities and fixed income trading hauls that beat analyst estimates. Though Citi's net interest income and margins fell short for the street, and there was a lot more to unpack around Citi as well. Let's talk to Charlie Wells, who joins us now. So Charlie, let's stick with the big picture story. What seems to be the driving factor behind the US bank's blowout quarter? A lot of them doing quite well.
A couple of features here, and I think when you tuned into those executive calls on earnings yesterday, you heard David Solomon of Goldman and Jane Fraser talk about how good the economy is doing right now. You heard Jane Fraser say something like, whatever you want to call the landing, it's optimistic. And so that is creating an environment that's great for banks. The lower rates are actually helping as well, because you get this sentiment of, deal pipelines becoming healthier than they have been in a long time. And also, as you mentioned, volatility, that has been really good. So against this backdrop of a strong market, you have volatility that makes players want to take part in that market and makes money.
Let's talk about that volatility. So much of that trading revenue has really helped, to your point, to prop up some of these bank results. Morgan Stanley is a little bit of a different story. We're getting results from them later today. But to them, it's kind of this wealth effect, right? Because of their wealth business. E-Trade as well was their major business that they had acquired. Does this change the narrative around banks, what we hear from Morgan Stanley today?
Well, it's going to be really striking because they have positioned themselves so squarely in that wealth corner. And I think from one perspective, the rise in equities should be beneficial for them, right? That should potentially bring that wealth, revenue up higher. But also, they are also positioned in that investment banking space, and we've seen banks that are more kind of positioned there, like Goldman, have really positive revenue on the investment banking front. So if Morgan Stanley in just a few hours can kind of bring in that strong wealth front, if they can also bring in that strong investment banking front, they should have some pretty solid results.
All right, Charlie Wells taking us through those bank earnings and looking ahead as well. Thank you for that. I just have to take us right back to where we started this programme, which is UK CPI. So we got undershoots at the headline core and services levels. And the reaction in gilts is really striking. The 2-year gilt yield lower 9 basis points at 4.03%. The 10-year lower 7 basis points at 4.09%. I think that's the lowest since October the 4th, if not lower. And actually, interesting commentary from Vander's Viraj Patel. He points out it's not just that CPI missed. This was one of the weakest September month-on-month prints for core over the last 25 years. And what's really interesting is he says it opens the door to a 50 basis point BOE cut in November.
Yes, and it's below the Bank of England's own estimates, isn't it, this reading on inflation? And that could be material when you're thinking about the read across from this number, whether it gives that green light for further cutting. And you were saying earlier, the market thinks November, but now the question is whether we get December as well then. That's the question for markets.
Well, we had Jane Foley as well on this program, really talking about it's all relative, it's all respective. Context is everything, for lack of a better term. But I think what's crucial here is that even with that decline, even with potential 50 basis points getting back into the equation, you're looking at cable at 130. You are still looking at strength relative to the euro, to the Swiss franc as well. We had this conversation over and over again on the show, basically saying that, yes, things are tough here in the UK, but relative to what's going on in France and Italy, et cetera, things may not be that bad. And I think that's really quite striking.
Yeah, interesting to link the currency then with what we see on the stock market then, Lizzie, because we see UK stocks doing pretty well this morning, up by 0.8%. Weakness in the currency, of course, if you're earning dollars overseas, that can help you when you translate that back into pounds. And so there's a sort of a knee-jerk read across there. And so the repricing of what's likely to happen at the Bank of England as a result of the weakness in this inflation data having an impact on a whole host of asset classes this morning. No doubt they'll pick up on the UK theme during the pulse. That's up next. They'll have plenty to talk about, plenty of stories to choose between. ASML, LVMH, lots to discuss. This is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
A lot's happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, only on Bloomberg TV and radio. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Shares in the chip equipment maker ASML tumble again after falling the most in 26 years on weak orders and guidance. Well, luxury giant LVMH also plunges after sales drop for the first time since the pandemic on cooling demand in China. Plus, Donald Trump dismisses criticism of his plans for more tariffs, speaking to us just 3 weeks before the U.S. election.
To me, the most beautiful word in the dictionary is tariff. And it's my favorite word. It needs a public relations firm. There are no tariffs. All you have to do is build your plant in the United States and you don't have any tariffs.
Well, let's take a look at the European markets map. There is quite a lot of pressure going on, not only on chip makers, but also some of the luxury stocks. So European equities seem to be falling apart from the FTSE. That's gained some 0.8%. That's an inflation story. We'll get to that in a second. But European equities, again, falling also on weak luxury prospects. This is because of China, but it's adding to negative sentiment around some of the profit outlook that we're already seeing from the semiconductor industry. Now, across asset, let's also look at what, of course, the Trump talking about the Fed means for treasuries, but the one we're really watching is sterling. You can see sterling 129.96, the pound sliding as a drop in UK inflation now seems to be spurring increased bets on interest rate cuts. So we'll have a packed show for the conversations that matter and the insights you need. Let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, Donald Trump has defended his plans to dramatically increase tariffs and seek greater influence with the Federal Reserve if he returns to the White House. Now, the Republican presidential nominee has been speaking to Bloomberg News editor-in-chief John Micklethwait.
We're all about growth. We're going to bring companies back to our country. To me, the most beautiful word in the dictionary is tariff. And it's my favorite word. It needs a public relations firm. I had a very good relationship with President Xi, and a very good relationship with Putin, and a very good relationship with Kim Jong-un.
Do you worry about that?
The dollar is so secure. Your reserve currency is the strongest it'll ever be. I think that if you're a very good president with good sense, you should be able to at least talk to him. I don't say make the decision at all. Take a look at Detroit. Take a look at our cities. We're a developing nation. We have to develop more than they do.
Well, with me now, Bloomberg's EMEA News Director Rosalind Matheson and Hugh Gimber, Global Market Strategist at JP Morgan Asset Management. So thank you both for joining us. Ros, we had this 1 hour long interview that our editor-in-chief did with Donald Trump. What did we learn in terms of his economic outlook?
Well, it's interesting to see the conversation. Obviously, he was talking primarily to a domestic audience with just weeks before the election. It's a compelling argument that the US has for years been taken advantage of by other countries around the world, that he would bring more of that business back. He would protect US companies, US jobs. That's what he's been talking about, obviously, when he was president previously and now as a contender. Of course, the reality is that putting major tariffs on countries overseas and companies overseas can do, detrimental effects on the US economy. We've seen that in terms of questions about how much revenue it brings in, what it does to inflation, what it does to economic growth. So really not clear it's going to benefit the US worker, the US companies in the longer term. But that messaging is, again, very clear that Donald Trump, what he sees around the world is everybody's a competitor. It doesn't matter if you're an ally. It doesn't matter if you're an adversary. In fact, he said in the interview yesterday that our allies have taken more advantage of us than our enemies. And that's a clear sign if he becomes president again. Watch out if you're the EU, not just China, but countries within Europe and so on.
And it seems now that actually both candidates just try and talk about the economy in the swing states. What are the polls telling us?
Well, the polls are so tight. I mean, even polls today show, again, they're basically neck and neck. Everything is within the margin of error, including in those swing states. You heard Donald Trump name, the key states, including Pennsylvania in particular, is going to be the one to watch on the night. But what it tells us is that voters are still either not telling people who they want to vote for, or they're really not sure who they want to vote for. And it's still anyone's guess how that's going to show up on the night. But absolutely number one issue really, when it comes to voting, we know this in every country around the world, tends to be the economy. And there's very little daylight between them on that front.
So, Hugh, when you look at, the Trump trade, how do markets position themselves ahead? Again, it's an election that's too close to call. It's maybe 200, 300 swing voters that will decide the outcome. Is a Trump trade, does that have automatic implications for dollar strength and treasuries?
So this is all through the lens of inflation for me. When you think about the key areas where policy can move, tax cuts is one, tariffs is two, and then a restriction on immigration is the third. All of those could lead to a slightly more inflationary mix moving into 2025. You look back at how the US has achieved its inflation target, not just over the past few months in terms of inflation coming down, but really over the past couple of decades, it's been via zero goods inflation. You paid the same for a basket of goods in the US in 2000 as you did in 2020. If we're going to see this more confrontational stance, as Ros mentioned, this sort of move towards competition against every trading counterpart, it feels very unlikely to me that we're going to be able to repeat that same kind of outcome with very, very low levels of goods inflation. So, to my mind, this isn't an election to pre-position for. As you say, this is looking incredibly tight, but we see a wider range of potential outcomes for Treasury yields into next year than we do in, say, UK gilts or particularly German bunds, where fiscal missteps have already been made.
Can he really continue with reshoring? I mean, a lot, if you look at the charts, a lot has already, manufacturing has gone back to the US. And actually, what does it mean for US exceptionalism longer term?
So US exceptionalism is built around excessive fiscal policy, right? We're already running a 6-7% fiscal deficit. You look at where the deficit will be headed if we do see tax cuts that are due to expire at the end of next year extended. I think this is often the piece that investors are missing. People point to the weakness in Europe, the weakness in emerging markets, and talk about how the US economy is just the standout. And the piece that we miss here is that it's being built on, frankly, unsustainable levels of debt. In a normal election cycle, you'd be looking at this debate and expecting a much clearer focus on how either side is going to try and fix the hole in the federal finances. And instead, we have this scenario where both sides of the aisle are looking for more expansive fiscal policy next year. So this isn't a clear call for higher Treasury yields. Ultimately, inflation will be the driver, but I do think it gives you a much wider range of outcomes.
Yeah, and of course depends on what happens with, of course, the houses. Rozar, John Micklethwaite also asked him about the potential replacement of Jay Powell. This is what Donald Trump had to say.
I think it's the greatest job in government. You show up to the office once a month and you say, let's see, flip a coin. And everybody talks about you like you're a god. Oh, what will he do? I think that if you're a very good president with good sense, you should be able to at least talk to him. I don't say make the decision at all.
I mean, it's a little bit more complicated than that. It's not a government job. I mean, Jay Powell works pretty hard. He was also a Donald Trump appointment, Roz.
Well, that's right. It's interesting to see. He was saying on the one hand he feels he should be able to pick up the phone and talk to the head of the Federal Reserve. But at the same time, it's not him to make the decisions about it. And that really is kind of creeping into that area for markets of unease about the level of intervention that you might get again. I mean, saying that he felt that rates were in the wrong direction when he was previously president, and then Powell overcompensated by, saying that he was alluding to the fact that he believed that Powell reacted to what Donald Trump was saying, whereas I'm sure Jerome Powell would say that he made decisions about interest rates based on the status of the economy and the economic outlook solely at the time. But we know, we've seen that from Donald Trump previously as president. We presumably would see it again, and that's that real level of sort of interventionist behaviour around all kinds of institutions in the US, economic or otherwise. You talk about the courts as well. I mean, all the different levers of government administration where you get that idea of separation of church and state. Donald Trump doesn't really believe in that. He believes he should be able to pick up the phone and talk to whoever. We see that even with his comments about whether he feels it'd be right to talk to Vladimir Putin from Russia, at a time that Russia's at war with Ukraine. So certainly those kind of separations would not exist again if he were to win the election.
Hugh, did the markets sit up and take notice of talk about, I mean, it's not really putting in question independence, but actually it's skirting around that?
It all comes back to the economy, because if the economy is holding up fine in 2025, if growth is still ticking along, if inflation's coming somewhere close to target, I suspect if it is a next Republican administration, they'll focus their guns elsewhere. They'll be thinking more about tariff policy, around the potential for passing a big tax bill, and I suspect they'll be happy to leave the Fed and let them get on with their job. I think it's under the scenario where the economy cools more quickly next year. If you do see the US slipping into recession, that things are likely to get noisier. Either way, there are checks and balances here, right? There has to be good cause for the president to try and intervene. One of the things that President Trump also mentioned last night was that while he'd like this communication, he still thinks that the president shouldn't be able to control what the Federal Reserve does. So we've heard lots of this before between 2016 and 2020. Ultimately, the Fed stayed independent then. I would expect the same to happen this time round.
Thank you both. Ros Matheson, there, of course, our EMEA News Director, Hugh Gimber, stays with us. Now, coming up, chip makers plummet after ASML misses estimates. We look at whether it's the start of a wider slowdown across semiconductors. That's next, and this is Bloomberg.
Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close.
Welcome to Balance of Power.
This is Bloomberg. From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Welcome back, everyone. We talked at length, of course, about Donald Trump. We talked at length about some of the concerns surrounding independence of the Fed. Now, the other big story today is UK inflation dropping below the target of the Bank of England. That definitely, and we've seen it in money markets, is boosting a case for a rate cut. So let's get back to Hugh Gimbert, global market strategist at JP Morgan Asset Management. Hugh, this is big news. I mean, if you're like a BOE watcher, you're like up and down in arms. I mean, what does it mean for, if you look actually at the fundamentals of this economy, I was always quite surprised that it was pushing back cuts mainly into next year. And I don't know whether that was because of wage negotiations. But does that change your perspective for BOE?
No, it doesn't. Is the short answer. So when you look at why inflation fell so sharply today, it's parts like airfares, it's motor fuels. These are the things that are really outside of the Bank of England's control. Go back to yesterday's data with the labour market. Wages, yes, are cooling, but they're running at close to 5% year over year. That is inconsistent with the Bank of England's inflation target. So I think today's print nails on the November cut, but it is too early to start thinking about even meeting-by-meeting cuts because the labour market is in just such a different position in the UK to the US or to the Eurozone that I still think the Bank of England would be taking a big risk if they feel now they can move into lockstep with the Fed and the ECB.
So how many cuts are you expecting?
So quarterly, I think, is the right base case looking out into 2025. That's still, gradually acknowledging that inflation is moving closer to target. But I think there's more work to do. The bank may well point to measures such as their super core and the different definitions that they're using. But there's always a danger here. Basically, if you strip out everything in the inflation basket that's going up, then no wonder the measures that are left are going to be going down. And so I think prudence is called for in the UK. If we were seeing a stronger recovery in terms of labour participation, that would be cooling wage growth, but that's simply not happening. Participation is still falling, unlike the US, unlike the Eurozone. So naturally, the temptation for the BOE to start thinking, oh yeah, maybe we can keep pace with the pack here, is going to be building, but that comes with risk because the UK economy is just in a different position.
What about the ECB? So we're expecting, of course, a cut on Thursday. Again, they have quite a lot of things that they're worrying about, notwithstanding inflation picking back up.
Yeah, I mean, the case for the ECB to be gradual is dead, in my view. They're talking about data dependence, but the data is sending a very clear signal that rates need to come down. They're in a very different position to the Bank of England. Look at manufacturing new orders in the Eurozone, 42.2 at the moment. This is an economy now which is crying out for lower rates because in terms of China, there's no imminent boost coming. In terms of the squeeze on autos, this is a sector which is experiencing not just cyclical challenges, but structural challenges. So for me, I think anything but a 25 basis point cut tomorrow would be a big surprise, but this is where we expect the guidance to start to shift towards that meeting-by-meeting pace because the Eurozone simply needs lower rates now.
But is there a danger that there's higher inflation, which I know has come down, but could resurge given all the geopolitics, with the lower growth rate, borderline recession?
I think that's less likely, and it comes back to the composition of the labour market. Eurozone wages are much more of a lagging indicator because of the very high level of unionisation. So this is more about the unions demanding compensation for inflation that's in the past. And so as headline inflation continues to cool, we're frankly less concerned looking at the Eurozone labour market and worrying about those second-round effects of sticky wages leading to persistent services inflation. So headline's going to be buffeted around, but it's the core inflation pressures that are moving back. And when you have such a more manufacturing-dependent economy, the manufacturing sector is where you would expect those rate cuts to be felt. So I think the case of the ECB is clear.
Chips are getting slammed. We heard it from ASML. There's also, of course, concern about the trade war being ratcheted up. We had a story yesterday about the Biden administration actually forcing NVIDIA to not sell to certain countries. And luxury is also being slammed. I mean, what's this earnings season going to look like? So
for me, this earnings season tells us there is more to life than mega caps, right? You look at the leaders this year, all of the popular names so far, I mean, ASML, LVMH, two good examples here where expectations have been built up, and there are multiple factors weighing on these companies. You look at some of the broadening out, though, that we're seeing, and this, for me, is an encouraging factor that sector returns are becoming much more evenly distributed. That's a healthy thing for the stock market. Go back to Q1 of this year, you had the Mag 7 in the US doing about 50% earnings growth. Everything else was in negative territory. By the end of this year, we think both of those segments are probably growing somewhere in the region of mid-teens. So for an index investor, that's a challenge, right? Because you have this rotation leaving you potentially standing still. But as earnings start to broaden, that's the catalyst that we've been waiting for a long time to start to see the gap in valuation that's been built up begin to gradually close.
Hugh, thank you so much for all of your insight. Hugh Gimber there, a global market strategist at JP Morgan Asset Management. Now, coming up, ASML, as we were saying, those shares continued to fall after missing estimates. We'll look at how curbs on the chip industry are hitting the whole sector. This is Bloomberg.
Fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
From NVIDIA to ASML, Tokyo Electron to TSMC, the highest of high-tech chip firms are caught ever more directly in the geopolitical crosswinds between Washington and Beijing. The stakes could hardly be greater, with America and its allies increasingly fearful of Chinese advances that might give it crucial technological and military advantages. From design by the likes of ARM and NVIDIA, to equipment from lithography powerhouse ASML, to materials to make the chips from the likes of Global Wafers, and manufacturing by the foundry giant TSMC, the global supply chain winds through many countries considered geopolitical hotspots. US attempts to box in China haven't always been successful. And it's not just the parts themselves. The Netherlands has curbed ASML's ability to maintain its high-end lithography machines in China, which could render some of them inoperable next year. Still, with such vast and intertwined supply chains, slapping restrictions on high-tech is harder than it looks. And then there's the risk of Chinese retaliation.
Well, Bloomberg's Tom McKenzie reporting there, and Tom is here to talk ASML shares in the Dutch chip equipment maker down again after falling the most in 26 years. Investors pretty spooked about the news that it booked not enough orders compared to what it was expected. Tom, what's going on? I mean, chips are getting slammed.
They really are. So this has, to your point, has that ecosystem impact, that impact across the chip sector, because of concerns of what this tells us about, one, AI demand, and also more broadly the demand around, for example, autos chips and industrial chips. And I'll get into that in more detail. But top line is they came in with orders well below the expectations, less than half. So 2.6 billion euros was the orders for the most recent quarter. The expectations had been they'd log 5.4 billion euros, so less than half. And they downgraded their forecast as well in terms of the forward guidance for 2025. So they now expect sales of between 30 to 35 billion euros. They had expected 40 billion euros. The newly installed CEO, Christophe Fouquet, saying the recovery is more gradual than expected, and that will continue in 2025. Customers, he says, are cautious. He says there is potential for some upside around AI. So he wasn't dismissing the gains that could come through from AI, but he really pointed the finger of blame at the industrial demand, the autos demand, and said that customers like Intel are cutting costs, and that's having an impact.
And China's not doing as well as expected.
Absolutely. So, of course, we know about the broader impact in terms of the macroeconomic picture of China, which, of course, remains challenged. And then there's the fact that you have these additional restrictions put in place from, of course, the US. Look, this is still a company, ASML, that gets 47% of its sales from the Chinese market. Into 2025, UBS analysts think that they could lose up to a quarter of their sales in the Chinese market could be lost as a result of some of these restrictions. Again, that's according to analysts from UBS. So they face vulnerability in terms of their exposure to China. They still ship into China some of their equipment, just not the high-end kit that is now blocked by restrictions. Further restrictions could mean fewer sales into China at a time, of course, of weakness in that economy anyway. What we're going to be listening for, the call is later today. They're going to be scrutinised in terms of what's happening in terms of the demand for the high-end stuff and what they think about that AI picture as well.
So important. Tom, thank you so much. Bloomberg Daybreak Europe anchor Tom McKenzie. Now, coming up, we're joined exclusively by the president of the European Bank for Reconstruction and Development as it announces its largest single foreign direct investment in Ukraine since Russia's invasion. That's next, and this is Bloomberg.
principles, our policies in support of the Palestinian people will never change. Our policy in having a two-state solution will never change, and nothing will compromise it. And as long as we are, having the capability to be helpful, we will do it. We did that between Afghanistan, between Taliban and the US. We did that between different parties in Lebanon and Sudan and others. And that's basically the core of our foreign policy. It's been built based on mediation, on trying to help in resolving conflicts between the parties. There are countries or people might not like it, but we don't ask everyone to like it, just to understand it.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
As we spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. Shares in the chip equipment maker ASML tumble again after falling the most in 26 years on weak orders and guidance. Luxury giant LVMH also plunges after sales drop for the first time since the pandemic on cooling demand in China. Plus, Donald Trump dismisses criticism of his plans for more tariffs, speaking to us just 3 weeks before the U.S. election. So let's stay with that story now. And Donald Trump says his policies will boost growth and bring companies back to the U.S. despite economists predicting otherwise. Now, the Republican presidential candidate says he'll offset trillions of dollars of tax cuts by raising tariffs on imports. Well, he spoke to Bloomberg News editor-in-chief John Micklethwait.
Because we're about growth. She's got no growth whatsoever, and we're all about growth. We're going to bring companies back to our country. You look at even today, as I was driving over, I see these empty, old, beautiful, like steel mills and factories that are empty and falling down. Some have been converted to senior citizens' homes, but that's not going to do the trick. And we're going to bring the companies back. We're going to lower taxes still further for companies that are going to make their product in the USA. We're going to protect those companies with strong tariffs, because I'm a believer in tariffs. I'm not sure that you are. I don't think you are, but I congratulate you on your career. But to me, the most beautiful word in the dictionary is tariff, and it's my favorite word. It needs a public relations firm to help it, but to me, it's the most beautiful word in the dictionary.
Tariffs, do you think that will bring in the revenues? To use another bipartisan group, Peterson Institute, they say they only bring in $200 billion. That is that's barely the cost of 2 of your promises.
Yeah, but that's like, for what company are you talking about, okay? Look, I've brought in with tariffs, and I was just getting started. Then COVID came, and we had because I tell you what, I did a very good job in COVID. Nobody knew what the hell it was. I call it the China virus because I like being a little more accurate. But when that came, but we got hundreds of billions of dollars just from China alone, and I hadn't even started yet. But tariffs are two things, if you look at it. Number one is for protection of the companies that we have here and the new companies that will move in, because we're going to have thousands of companies coming into this country. We're going to grow it like it's never grown before, and we're going to protect them when they come in, because we're not going to have somebody undercut them.
Donald Trump also declined to say if he had spoken to Russian President Vladimir Putin since leaving office in 2021.
Well, I don't comment on that, but I will tell you that if I did, it's a smart thing. if I'm friendly with people, if I have a relationship with people, that's a good thing, not a bad thing, in terms of a country. He's got 2,000 nuclear weapons, and so do we. China has a lot less, but they'll catch us within 5 years.
Meanwhile, Ukrainian President Volodymyr Zelensky says he'll present what he calls his victory plan to his country's parliament today. Now, Zelensky has been seeking fresh aid from his European allies amid fears of dwindling support if Donald Trump wins the U.S. presidency next month. The European Bank for Reconstruction and Development has also announced its largest single foreign direct investment in Ukraine since Russia's invasion. Now, together with the International Finance Corporation, it plans to provide $435 million in long-term debt to one of the country's leading telecoms group. Well, we're now joined exclusively by Odile Renaud-Basso, president of the EBRD. Also with us, Bloomberg senior writer Stephanie Baker. So thank you both for joining us. Thank you. When you look at what Madame Renaud-Basso, what the EBRD has said, I mean, this is a large chunk of investment that basically goes into fiber optics. I mean, how is it so important to rebuild some of the infrastructure, especially infrastructure that loses less energy still in the time of war in Ukraine?
So it's very important because having a foreign investor putting such a big amount of money in Ukraine is a very strong sign of confidence. So that's the first element. The second one is on the technique itself. Bringing together a mobile telephone company and a fixed telephone company will bring a lot of benefits, and the company will start investing more to develop the network, improve the energy efficiency, improve the cybersecurity, and so forth. So the investment will benefit 10 million of people in Ukraine. And as we know, having strong telecom communication tools is very important in the war situation for the business to be able to continue, for people, and for the country itself. So it's a very positive news.
How difficult is it to do this in again, an active war? Because you don't know, things can be hit, you have to go back. How difficult is it to find the money?
So it took us a lot of time. We started a discussion with the investor, the French investor, Gavenil, before the war, so in 2022, in 2021, before the war started. Then it was suspended at the beginning of the war and then started again, and it took a lot of time to build the package. But there we are, and I think it's very, very good news.
Stephanie, I have so many questions. I mean, the interview that John Micklethwait did with Donald Trump yesterday probably means that we don't fully understand whether he did speak to Vladimir Putin after he left office or not. But what do we know if President Trump, is in the White House come January 20th? What will he do with Ukraine and Putin? What do we know?
All we can do is go off of what Trump has said he will do. He wants to end the war. He says he can end it in a day by talking to Putin and talking to Zelensky. J.D. Vance has outlined more details, but it does look like they would declare a ceasefire, cede control to Russia of Ukrainian territory, and possibly lift some sanctions as an inducement. Now, whether or not that would work, whether or not Putin does not seem like he's ready to stop fighting. So I think it's a lot easier said than done. And I think there's obviously real concern in Ukraine that they will be abandoned and that either way, whatever deal might be done, that they will not be receiving the amount of U.S. aid that they have so far.
Will it be more difficult to find that money in Europe, given that they potentially also have to deal with the terrorists coming from the White House?
Well, I think Europe has stepped up and will step up financially, but it doesn't have the defense base to provide the amount of military aid that Ukraine really needs. It really needs the U.S. involved. And I think that is going to be a major challenge, even if Europe is able to provide additional financial aid. Where is it going to? Already, we're facing low stocks, both in Europe and the U.S. So I think that's a real question mark going forward.
Odile, we spoke last month again about the long-term reconstruction plan of Ukraine. Again, very difficult when it's still an active war zone, so you don't know how long or what will be needed in 2-3 years. But what are some of the key sectors that you're also working on?
No, I think what is very important, first of all, is to secure the financing for 2025. And the good news is that Europe has decided on mobilization to 35 billion euros. Is already, in macro-financial assistance to support the budget. And I think there is a lot of discussion with the US ongoing on how to implement, the mobilization of the revenues from the frozen assets. So that would secure 25, and is very important. And for us, for the reconstruction, so continuing to work on the infrastructure, rebuilding of the key infrastructure. The energy sector remains one key challenge in the short and medium term, but also manufacturing capacities and so forth. The good news is that the exports, thanks to the agreement on the Black Sea and the situation with the Black Sea, have increased again, and Ukraine has some external revenues related to export in agriculture and manufacturing products.
Yeah, so you deal, of course, with rebuilding Ukraine, but you need the package also to defend Ukraine. Do the two come hand in hand?
I think they have to. And, as I went into in my book, Punishing Putin, this whole debate over using frozen Russian sovereign assets is really key. As she said, they have figured out a way, Europe at least, to leverage the interest payments from that pot of money in Europe for this 35 billion euro loan, but the U.S. needs to step up as well. And I think there'll be increasing pressure on using those assets in a greater way to try to aid Ukraine. The costs of rebuilding Ukraine are enormous, and so projects like the EBRDs are really important in terms of signaling to other investors that there's confidence and providing the infrastructure that they need to go in.
How much of this is also private money, or how much money will you need from the private sector?
A lot of financing from the private sector will be needed. Now it's difficult, but we see it's possible with the project we just financed in the telecom, but more will be needed, and more will come when the situation will be clearer in terms of war. But, overall, our contribution up to now has been 5 billion since the beginning of the war, which is already quite a large input. And I think that the connection between supporting the macroeconomic, the budget situation, and the military is very important. One positive news also is the fact that the Ukrainians have developed their own capacity, military production capacity in drones and so forth, and they have some high technological skills, which is helpful. It doesn't sort everything, but it's an important contribution.
One of the main stories that we're also trying to focus on is the expiring gas transit deal. That feels very significant, like gas transiting, through Ukraine. Does that change everything?
It could change a lot, and then there are a lot of discussions around that, because some countries in the EU are still very dependent, like Hungary, Slovakia, and so forth. So there is a lot of discussion around this issue, which is, of course, is quite strategic.
Stephanie, do people care? And I think we've talked about this in the past. Do people in the U.S., when they go and vote on November 5th, do they care whether, Donald Trump spoke to Vladimir Putin once he left office or not?
Obviously, foreign policy is not the major factor in U.S. elections, but given the prominence that Putin has played in U.S. elections over the past 10 years, I think it could influence the continuing doubt over Trump's relationship with Putin is a worry and is an attack line that Kamala Harris can use to go after Trump. And the fact that he's waffling on this. Last week he said he denied this report by Bob Woodward that he'd spoken with Putin and said that it was, Bob Woodward was just a storyteller and a bad one. Now he's refusing to say yes or no, and he didn't deny it yesterday, which I think is significant. It only deepens the sort of speculation about what really went on, what did they say, did they talk, and about what.
Thank you both for joining us. Odile Renaud-Basso there, president of the EBRD, and our very own Stephanie Baker, who's also the author of Punishing Putin. Now, coming up, we're in the middle of earnings season for the Wall Street banking heavyweight, so we'll break down the numbers next. This is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
DOJ or other authorities
Could face bigger challenges next.
Was going to keep Rain World Cup. This is a 3
as the economic picture.
covering the intersections of Hollywood, Silicon Valley, and beyond.
A lot's happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, only on Bloomberg TV and radio. Context changes everything.
Welcome back, everyone. Now, Citigroup shares disappointed during Tuesday's trading session, despite its traders turning in its best third quarter performance in at least a decade. Now, it was among some of the big U.S. banks that reported earnings yesterday, with Goldman Sachs and Bank of America. Later today, we'll get an update from Morgan Stanley. I'm delighted to, of course, now talk to Charlie Wells and Paul Davies. Paul, you have a great, thank you both for joining us, but you do have a great piece that we need to get back on, saying Wall Street bonuses have just been salvaged. So I know a lot of people watching from the trading floor will probably be like, whew, I'm so glad he wrote that. But Charlie, what seems to be the driving force behind these banks?
It's really interesting. You know, there were some positive earnings calls yesterday, and when you tuned in, you could hear the CEOs talking about how good they feel about the economy right now, especially when you listen to Jane Fraser of Citigroup. She said, whatever you want to call the landing, it's positive. David Solomon at Goldman was talking about, you know, increased optimism for a soft landing, so that was one element. You also have this lower rate environment that we seem to be going into that is looking like it's going to spur more activity. That's great for banks. And then also volatility. More people want to trade when things are more volatile.
So, Paul, we had this unexpected boost, right, deal-making and trading activity that came late in the third quarter. First of all, why? And what does it mean for the prospects for next year and bonuses?
Yeah, well, so it's quite interesting. There was a bunch of warnings from the different banks about, you know, their revenues and what they were going to look like earlier in the third quarter. And then, like you say, we did get this late boost. There was a bunch of strategic deals that were brought forward and closed early. You know, debt capital markets, you know, bond issuance has been the thing that's been, you know, going great guns all year. And we saw a whole wave of that as well. I mean, I guess, you know, the issue is that some of this stuff might just be robbing, you know, activity from the fourth quarter. But like Charlie was saying, you know, the CEOs, particularly at Goldman, were very positive about, you know, the pipelines that they have, as they always are, but, you know, they were very positive about the amount of
this
kind
time
of,
for real.
Yeah, more strategic activity coming through, you know, in the fourth quarter and into next year. And obviously a lot will depend on the election, but it seems like there's kind of real M&A building.
But I mean, Citigroup also had this massive overhaul. I mean, they brought in, like, you know, the JP Morgan's biggest banker in London. So is it always also a testament that, you know, things are working there, or is it too soon to tell?
Well, it's very interesting, Citigroup. I mean, in many ways, it looks like they've turned the corner in terms of generating better revenue, especially in the markets business and the investment bank, you know, really good numbers compared to what they've been clocking recently. But at the same time, they're still kind of struggling to sell the story on expenses. They had this kind of weird moment on the analyst call where Mike Mayo was asking them about whether they're going to have an asset cap or not, which I think all fed into the share decline. And they obviously kind of, you know, went backwards on their returns on equity as well slightly, which, you know, is always going to worry investors a little bit.
What are we expecting from Morgan Stanley?
This is going to be an interesting story. So Morgan Stanley, of course, very positioned in wealth management. And, the boost in equities could be, a great story for them to tell there. What a lot of analysts are going to really be looking at with Morgan Stanley is cyclicality. So a lot of the other huge banks have been able to kind of tell the story of, whatever environment we're in, good or bad, we're able to make money. Can Morgan Stanley tell that same story? It's looking like they might take a hit on net interest income. It's looking like investment banking will be great for them now, but how do they become a sort of all-weather bank?
And Paul, how are things, changing for a lot of the big financial firms? So some of the big asset managers are also looking at private credit, private equity, hedge funds. So what does it mean for the banks?
Well, so this has been, a great business for the banks in recent years, particularly in their markets businesses. And they've all been focusing on, as they try and compete against the execution businesses of Citadel and Jane Street, Citadel Securities, I should say, and Jane Street and all those people, they have been trying to do more financing of their big clients. And as private assets have grown, as exits have been more difficult and, they've found it harder to get money back to their own investors, the banks have stepped in, found new ways of lending more and more money to private equity, to private credit, and also to the big multi-strategy hedge funds that have been growing and taking on a lot more leverage as well. And that's been visible in Goldman's, financing numbers in its market business. Less visible, but we know it's there in Bank of America's markets business as well, and in JP Morgan and across the street. And they've all been doing very well off of that.
What does it mean for pay? I mean, I read, it wasn't our own opinion column, but something, about interns at, for example, Jane Street being paid more, I think, than Jay Powell. I mean, do you see it in some of the bonuses, the difference, depending on what part of the financial sector you're in?
Yeah, I think so. I mean, I think, obviously it's going to be it's been a better third quarter than lots of people expected in markets. I think it will be a better full year than lots of people expected in markets for the investment banks. Their pay isn't going to go off the charts. And, and when you're talking about Jane Street and Citadel Securities and people like that, they have far fewer people handling much larger volumes of business because it's all about computers and technology and so on and so forth. So, perhaps they probably will continue to get paid better than almost everybody else.
Okay, so interesting. Thank you both for joining us. Charlie Wells and Paul Davies joining us on the banking sector. Now, don't miss our interview today with Ted Pick, the chief executive at Morgan Stanley. That's at 3:30 p.m. UK time. Coming up, we talk luxury. LVMH sales fall for the first time since the pandemic. We look at why the luxury goods maker is failing to catch the eye of Chinese consumers. This is Bloomberg.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Earnings. I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, is emissions.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
Now, the AI boom has caused demand for energy to surge globally. Google, Microsoft, and Amazon are turning to nuclear power as an energy source for data center. Well, we discussed AI's environmental impact with Estelle Prakianov, the chief executive of the world's largest environmental services company, Veolia.
AI can be part of the solution and is a problem at the same time. So if I start with the problem, AI, data centers, they consume a lot of energy, and they need a lot of water. So actually, we're providing services to the companies which are doing AI, and it's a growing market. On the other side, AI can benefit ecological transformation and saving water, saving energy, saving CO2, and so on and so forth, and can make a company like Veolia more efficient.
Well, you can watch the full interview of Leaders with L'Aqua Goes Green, airing at 9:30 p.m. New York time tonight in the U.S. and at 6:30 p.m. London time on Thursday. Now, staying with French corporates, and LVMH shares have continued to tumble in early European trading after the luxury goods giant missed estimates with its third quarter earnings. Well, Bloomberg's Andrea Felsted joins us with the very latest. Andrea, you were ahead of the curve. You said, there's going to be a pricing problem, especially if China's so weak. What did we learn on LVMH?
We learned that there has been a real slowdown in China. Now, LVMH played down the impact of pricing, but obviously prices have gone up a lot over the last 5 years. That China weakness is really a problem for the industry.
So who's doing well and who's not?
Well, I was surprised how weak LVMH was. They are one of the stronger names. I think when we get the slate, the full slate, they won't be at the top, but they won't be at the bottom. I think Hermes is still very resilient. Prada's having a fashion moment. They'll probably be the leaders.
So, Andrew, when you look at, I guess, the bad news that has been coming in because of China, because of a number of other factors for luxury, are we near the end of the bad news?
We're probably nearer to the end than the beginning. If you think luxury started slowing a year ago, things really deteriorated over the last 3 months, but they really did start to slow. There was a lot of talk about normalization. Plus, we've got the China stimulus coming in. And LVMH also said they'd seen a slight improvement in the US and in Europe.
So going forward, what do you look at? It's not really a barometer of how the consumer or how, it's not really a recessionary barometer, but it gives us a good indication of how people are feeling.
It does, but also I think there have been a few own goals from the brands as well. The pricing, obviously. There was that big move to quiet luxury. It's a bit dull. They really need to, LVMH talked about product innovation, reviving, the desirability of products. If you look, there's been quite a lot of change at the top of its designers. That all indicates they are trying to sort of, really reignite the brands, re-energize them, to give consumers a reason to buy. Don't forget, we all bought a lot. In the pandemic, couldn't go on holiday, couldn't go out for dinner, we bought luxury goods, probably haven't needed another new handbag. So there really is a reason, you need a reason to encourage consumers to buy now.
Andrea, thank you so much. As always, it's also interesting the fact they're trying to get more aligned with some of the sports, right? Yeah. Be it Formula One or the Olympics for LVMH. Andrea Felsted there from Bloomberg Opinion. Up next, Bloomberg Brief, Danny Berger in New York, and this is Bloomberg.
biggest risk in property and casualty, is that now climate change?
Yeah, so absolutely. When you look at natural catastrophes, the number of events has significantly increased, and not only the very big events like hurricanes, but also what we call secondary perils, so wildfires, floodings, and drought. And this leads to the fact that you have far more events and therefore a much higher cost of all of the natural catastrophes.
How do you really assess the risk of climate change? Because how can you possibly know whether there's going to be a hurricane or a flood? Is it just based on the past or the projection of the future? Or how do you do that?
Since the dynamic has changed, we need to also look forward. And what we do a lot, we work a lot with scientists who understand what the warming of the Earth and climate change will mean for the question of taking risk. And secondly, we take much less risk than we used to take because we have to be careful.
So let's suppose there are a lot of hurricanes. Is that good for property and casualty insurers or not? Good because people say, well, there's going to be more hurricanes, I should buy more insurance, or not good because you got to pay a lot of claims?
It depends. I would say it's good because it creates the awareness to do more prevention. What we see today is that, as I said earlier, there is more events. It becomes more and more difficult to insure, and therefore we work a lot with our customers around preventions.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the Good morning from our global headquarters in New York. I'm Danny Berger, Managed Cranny on a well-deserved break this week. Welcome to Bloomberg Brief. Let's set your agenda. Tech tanks. Over $420 billion is wiped off global chip stocks after ASML slashes guidance. All about growth. Former President Trump defends his economic plan in an interview with Bloomberg. We'll bring you more from that exclusive conversation. And Morgan Stanley will wrap up a strong earnings season for the biggest banks on Wall Street. Strong Wall Street earnings couldn't save us, though, for yesterday. It was all about tech. We slipped from record highs yesterday. This morning, we're basically little change for the S&P. NASDAQ and Russell 2000 are stronger. ASML, though, still cratering in the Netherlands trade. It was this tech stock that led everything lower, including NVIDIA yesterday. Shows the risks of relying on big tech. When it comes to this bond market, yields also moving lower. We have oil moving lower, less geopolitical risk. That's part of it. Also partially led by UK bonds. Those are coming in. Sterling also dropping this morning below 130 for the first time since August after UK inflation coming in below 2%, setting the stage for more BOE cuts. So the risks are rising in the U.S., more uncertainties, and on that, BlackRock's Vasiliki Pachatoridi writes that we have more confidence owning duration in Europe bonds versus U.S. dollar bonds. Vasiliki joins us now. I'm pleased to say she's the head of EMEA iShares fixed income strategy at BlackRock. So Vasiliki, questioning American exceptionalism in bonds, why?
Good morning, Danny. Thank you for having me on the show. Indeed, we do have a preference for owning European duration, but I think the context in that is slightly different. I mean, we are expecting the ECB to cut rates tomorrow by 25 basis points, but that's obviously expected by markets. But I think what's interesting is going to be absorbing that pivot in their reaction function, right? So they're now moving into a monthly back-on-back rate cuts, accelerating the pace of cutting, and that puts them on a more dovish path. So that's good for owning duration in Europe. And then the reasons that you mentioned earlier around the US, I mean, not questioning that the U.S. economy obviously is much more resilient at this point than the European economies, but it's more down to the uncertainty, policy uncertainty, political uncertainty over the next couple of weeks, and that's why we're more cautious and selective on U.S. duration, still having a preference for the belly of the curve, but overall leaning on duration in Europe and other tactical opportunities that we can talk about.
Basically, is it then your assumption that the European rate cutting cycle looks something steeper than that of the U.S., or maybe equally as steep? Because it is a
As I said, the ECB is now signaling that they're going to pick up the pace. It's going to be the first month-on-month cut that they're going to announce probably tomorrow. But I think it's also about kind of understanding that the reason for the next cut is going to be to fight growth. It's not going to be to fight inflation. So a very different rationale for where cuts are coming from between Europe and the US at the moment. But having said that, I think the overall picture that we're seeing in terms of markets and what investors are doing, we do see significant money in motion that has really started earlier in the summer. I mean, if I look at bond ETF flows, we had a record quarter in terms of people, kind of investors moving back into fixed income, trying to lock in yields before we see the descent of interest rates picking up the pace. And of course, like looking for relative opportunities in Europe, in the US, in parts of the credit market, which I think is very interesting right now.
Yeah, it's that reinvestment risk we've heard so much about. But the credit market itself, I mean, it could scarcely be more optimistic. Spreads are so tight, and any sort of these bouts of risks we've seen in other assets, it hasn't really showed up in credit. Vasiliki, how much of that is resilience versus complacency?
I think the story about credit and what credit offers in portfolios right now, I think it's twofold. There is a very powerful carry component. I know you asked me about spreads being tight, but if I look, for example, at the Bloomberg Global Ag this year, nearly 80% of the returns in the bond market this year are coming from carry as opposed to capital appreciation. If I look at places like European investment grade, nearly 85–90% of the returns are coming from carry. So the income back into fixed income is driving returns, so that's very important. And then the risks that you asked me about, I cannot foresee anything significant happening in the market that would cause a spread widening to happen at a big scale right now. I mean, the global growth is holding up. Central banks are cutting rate. This is a good environment for quality assets. And again, within the different markets, we do have a preference for European credit versus US credit.
Well, you compare the steadiness with credit with what's been happening in the Treasury market, Vasiliki, this oscillating back and forth between different narratives, from inflation concerns to recession concerns to now no landing seems to be the current narrative. But within that, you have this type of bond market volatility that has really captured markets this year. What does that mean for bonds in their traditional place as sort of a staid asset class for diversification and protection in a portfolio?
That is a great question, Danny. And indeed, if you think about US Treasuries, I think the diversification benefits that you get from Treasuries, I'm not going to say they're absent, but I'm going to say they're not so reliable anymore. I think on the longer end of the curve, if you look at 10-year and above, I mean, the fiscal uncertainties are only going to rise regardless of the election outcome in a couple of weeks' time. And if you look at the front end of the curve, I mean, I do think it's much more fairly priced today than it was maybe back in August with the inflation data that we got and the strong NFP. But between now and a couple of weeks' time, you have, again, NFP numbers, you have election, you have another Fed meeting. So I think I'm not going to be buying the 2-year right now. And I think, as I said earlier, if you are considering where to spend your fixed income budget between now and year end, I would lean into spread assets. And this is what we're also seeing from bond ETF flows. The acceleration in IG credit flows into ETFs has been quite significant the last couple of weeks and months.
When it comes to emerging market local FX bonds. How do you view a cutting rate cycle from the Fed that helps them, but then also that threat of the election that you were talking about, the threat of increased tariffs, of Trump yesterday talking about 2,000% tariffs on cars coming in from Mexico? How do you weigh the two pulling factors?
Yeah, that's a very interesting question. So emerging market debt as an asset class, let me start by saying it has been significantly under-owned for many years. So the investment positioning argument is not there, but that hasn't precluded the asset class doing really well this year. I think hard currency emerging market debt is probably the best performing fixed income asset class in 2024. And now that we are seeing kind of the Fed being into a cutting cycle, and again, global growth overall holding up, this is an environment that emerging market debt can do well. Of course, risks do exist, but again, taking cues from history over the last couple of years, we've seen emerging markets being much more resilient in the face of adversity. So I do think emerging market debt is interesting for income and diversification, but again, selectivity is key.
Vasiliki, really great to get your thoughts this morning. Thank you so much for joining us. That is Vasiliki Pachatoridi of BlackRock. Okay, to some other stories that are trending on the terminal this morning. UK inflation has slipped below the Bank of England's 2% target for the first time in 3.5 years. CPI came to 1.7% in September. That is cooler than expectations. The pound weakened. Money markets, meanwhile, boosted wages on back-to-back cuts in November and December. The International Energy Agency is predicting that the world will enter an era of cheaper energy prices. In its long-term report, the IEA said supplies of oil and gas will climb and demand for fossil fuels will cease to grow in this decade. Meanwhile, the surge in electricity use will continue on. And Ken Griffin has found a buyer for one of his luxury properties in Chicago, but at a loss. The Citadel founder's penthouse went under contract for an undisclosed amount, according to Zillow, but it was listed for $11 million in July. Griffin had bought the property for roughly $21 million in 2017, that according to Cook County records. He never lived in the 38th floor residence, and it was marked as unfinished. Coming up, we're going to take you to the chipmaker plummet, ASML's sales warning, and a premature release of their earnings. We're going to talk tech next on your Bloomberg Brief.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
earnings season is here.
I think that this earnings season is going to be so important.
Bloomberg is first to break the numbers.
NVIDIA earnings now crossing the wire.
Bank of America, the retailer Five Below.
There is something for everybody.
With the smartest insights.
Weaker inflation is not great for earnings.
I think the consumer's a bit more resilient.
You've had earnings recessions flow through growth and then cyclicals and defensives.
Earnings cycle continues on Wall Street.
Continuing coverage on Bloomberg. Context changes everything.
It's your Bloomberg Brief. Danny Berger here in New York. An accidental earnings release and a $420 billion sell-off. ASML sparked a global rout in tech after it posted a tepid outlook, tempering enthusiasm for AI and semiconductors. NVIDIA also selling off in the aftermath of that. Let's get over to Bloomberg's Tom McKenzie on this. Tom, what did the earnings show us, and why such a bad reaction, the biggest sell-off since 1998 for ASML?
Yeah, look, Danny, this was absolutely brutal in terms of the numbers that came through and the stock reaction, as you say. Really crucial is what it tells us about that AI demand, and I think there's a big question mark over that. But in terms of the numbers, they came through. The most recent sales in terms of orders of 2.6 billion euros, well below, less than half the estimates of 5.4 billion. And crucially as well, they cut their guidance for the fiscal year of 2025. They now see potentially sales of between 30 to 35 billion euros. They had seen 40 billion euros. The finger of blame pointed by executives at ASML at industrial demand, so soft industrial demand, soft demand in terms of chips that go into automakers as well. The newly installed CEO, Christophe Fouquet, saying, and I'm quoting, "The recovery is more gradual than expected. It will continue in 2025. Customers are cautious." And by customers, think of Intel cutting costs, but also over in South Korea, SK Hynix and Samsung, two other major customers for this equipment. Of course, the lithography equipment that ASML produces, they are also more cautious. But let's not forget that he did say that there is still some optimism around the AI story.
Tom, I just want to go over this headline that came in late yesterday. Qualcomm is said to wait for a U.S. election to decide on whether or not to buy Intel. What are they waiting for, and what does it tell us about the potential political environment we could be entering into after this election for tech?
Yeah, look, it's a real reminder, isn't it, of how political uncertainty affects business decisions. And this would be a major business decision with major consequences for the US economy and the global economy as well. Qualcomm reportedly then looking and weighing up a potential bid for Intel with all the challenges that Intel, of course, faces. And we touched on part of them in terms of cost cutting and reducing their plans and their ambitions around building out their own foundries in the US. They are clearly, Qualcomm wants some clarity in terms of who the next president will be and how they lean on antitrust. And we know the Biden administration's antitrust push has got teeth. We've been reminded of that in recent weeks around the scrutiny of some of the big tech players. They want some clarity as to who's going to be in office. They may wait then until post-November the 6th, or even push it back until January when the new president, of course, is firmly in the hot seat. So that seems to be a consideration. They've also reached out, interestingly, to regulators in China, a crucial market. Big sales of Qualcomm into the Chinese market and Intel. They want to get some assurance from China as well in terms of their anti-competitive push. So far, the Chinese have stayed muted because they want to know that this deal is really in the offing.
Yeah, a lot of factors to consider. Tom, thank you for walking us through them. Bloomberg's Tom McKenzie. Another set of earnings that also disappointed yesterday, LVMH. This morning in the European trade, shares down some 3.2%. Sales of fashion and leather goods fell for the first time since the pandemic for the French luxury giant. Let's get over to Bloomberg's Caroline Conan on this. Caroline, first of all, great to see you. LVMH had been one of those luxury companies that had been resilient during some of the downturn for the others. Why the change in fortune?
Yeah, and usually they are resilient because they have 75 brands, but clearly even the strongest brands are impacted by the slowdown in China. And today, shares earlier were actually losing as much as 7% for LVMH. They missed in every single unit. If you take fashion and leather, obviously that includes Louis Vuitton, the sales in that fashion and leather unit down 5% in the quarter, much worse than expected. And actually, the first actual drop since 2020 the pandemic. The Chinese consumer clearly is still reluctant to buy these expensive handbags, and the recent stimulus that we've seen in China is not actually quite yet reflected in the third quarter. The other divisions, as you can see, wines and spirits also getting smashed, -7% in the third quarter. Consumers are buying less champagne. In fact, the harvest has also been very bad recently for champagne, and cognac makers also are suffering, and they're going to suffer perhaps even more with these new Chinese tariffs on cognac makers, which is a retaliation from the EU tariffs on Chinese EVs that we have seen over the past few days. So very bad set of sales numbers for LVMH in the third quarter in China, in the US as well. Analysts were expecting a pickup, and in the US, actually, sales, there was zero growth there.
Caroline, thank you so much. That's Bloomberg's Caroline Conan in Paris. Just another quick earnings to check on. We had a lot of the big banks yesterday. Citi and Goldman shares both dropped in the trade. Bank of America, the sole one that could end the day higher. That was despite trading across the board looking really strong for these companies. Citigroup had their third best quarter performance in at least a decade. So again, all those reported, but now all eyes turn to Morgan Stanley. We'll get those results before the bell. Again, Morgan Stanley shares up about 0.25%. People are going to be watching out for what their trading looks like, how big of an impact that robust stock market also had on their wealth management unit. Okay, coming up, we're going to bring you part of our exclusive interview with the former President Donald Trump. That's to come. This is Bloomberg.
Top names in business are on Bloomberg.
The challenge for us now is not very much on the product, it's on the ramp-up of the production system.
We turned the industry down to almost zero during the pandemic. And what we're trying to do now is turn it all the way back on. And that's hard. We lost not only people during the pandemic, we lost a tremendous amount of experience.
A lot of skilled people have left the industry. We have to hire new people. The supply chain has to hire new resources and train the people, educate them.
And because those roles are filled now not by a 58-year-old, but perhaps by a 28-year-old, there's a lot we have to do in terms of not only adding capacity, but capability to meet the ramp that we all are embarked upon.
We have thousands of suppliers, and when you have just a couple of them, few of them that are late on the ramp-up, well, that's slowing down everybody, and that's what we've been facing earlier this year.
Nobody covers business like Bloomberg. Context changes everything.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
It's Bloomberg Brief. I'm Danny Berger in New York. Let's get you some front page news, just a look at what's making headlines around the world. First up, the New York Times leads with this, that the U.S. is warning Israel to increase aid to Gaza or face consequences. The warning was sent in a letter on Sunday to 2 top Israeli officials. According to that letter, failure to allow the delivery of more aid within 30 days could trigger a cutoff of U.S. military aid. Next up, we have this on the Bloomberg. Harris says that reparations for Black Americans deserve a review. The vice president spoke on the need for the issue to be studied in response to a question during an audio town hall. She also urged Black Americans not to be fooled into sitting out of the race, echoing similar comments from former President Barack Obama. And the Washington Post leads with this one. Elon Musk has given $75 million to his Own America PAC in a push to elect Donald Trump. Musk's contribution is part of a larger wave of fundraising hauls that were reported on Tuesday. Kamala Harris's primary fundraising, for its part, the vehicle announced that it had brought in $633 million, 5 times more than the main Trump fund. Let's stay on the Republican nominee because Donald Trump spoke about his economic plan with Bloomberg editor-in-chief John Micklethwaite at the Economic Club of Chicago yesterday. Here's some of that exclusive conversation.
Because we're about growth. She's got no growth whatsoever, and we're all about growth. We're going to bring companies back to our country. You look at even today, as I was driving over, I see these empty, old, beautiful, like steel mills and factories that are empty and falling down. Some have been converted to senior citizens' homes, but that's not going to do the trick. And we're going to bring the companies back. We're going to lower taxes still further for companies that are going to make their product in the USA. We're going to protect those companies with strong tariffs because I'm a believer in tariffs. I'm not sure that you are. I don't think you are, but I congratulate you on your career. But to me, the most beautiful word in the dictionary is tariff. And it's my favorite word. It needs a public relations firm to help it, but to me it's the most beautiful word in the dictionary.
Tariffs, do you think that will bring in the revenues? To use another bipartisan group, Peterson Institute, they say they only bring in $200 billion. That is that's barely the cost of 2 of your promises.
Yeah, but that's like, for what company are you talking about, okay? Look, I've brought in with tariffs, and I was just getting started. Then COVID came, and we had because I tell you what, I did a very good job in COVID. Nobody knew what the hell it was. I call it the China virus because I like being a little more accurate. But when that came, but we got hundreds of billions of dollars just from China alone, and I hadn't even started yet. But tariffs are two things, if you look at it. Number one is for protection of the companies that we have here and the new companies that will move in, because we're going to have thousands of companies coming into this country. We're going to grow it like it's never grown before, and we're going to protect them when they come in because we're not going to have somebody undercut them.
Former President Donald Trump not backing down from a protectionist agenda, saying that tariff is the most beautiful word in the dictionary. Interesting, Marco Popic of BCA Research saying that maybe Trump is angling for more of a Nixonian grand bargain with China rather than taking a McKinley-type trade war fight with China and trying to win it. We're going to have more on that interview and politics later in the show. A quick check on your bond market this morning. UK yields plummeting. The front end is down 10 basis points, 10-year down 8 after UK inflation coming in below 2%. Does that mean the BOE is going to switch to the dove mode? They have a meeting, and we'll get comments from Andrew Bailey next week, but that's leading to a rally throughout sovereign bonds this morning. U.S. 10-year yields down nearly 3 basis points. Coming up, consumer debt delinquencies, fears, those are at their highest since 2020. We're going to discuss with Garrett Milson.
recent years, you created an institute, the Jane Goodall Institute, and what is that designed to do?
Well, that was started in 1977 when by then I had a little research station and 4 of my students were kidnapped and everything shut down. And so some friends of mine said, well, let's start an institute so that this research can carry on. Bless them. So that was 1977, and it was set up to study, conserve chimpanzees and other animals and educate. And it's developed since then. So it's, you know, we've got 27 Jane Goodall Institutes around the world. And then I realized at some point that the African people living in and around chimpanzee habitats right across Africa were struggling to survive. There was crippling poverty, lack of health and education, moving deeper into the forest, being exposed to diseases like Ebola and HIV from the chimpanzees and vice versa. It hit me. If we don't help these people to find ways of making a living without destroying their environment, conservation won't work.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
From our global headquarters in New York, welcome to Bloomberg Brief. I'm Danny Berger. Let's set your agenda. Tech tanks over $420 billion wiped off of global chip stocks after ASML slashes guidance. And it's all about growth. Former President Trump defends his economic plan in an interview with Bloomberg. We'll have more on that exclusive conversation. And Morgan Stanley set to wrap up a strong earnings season for the biggest banks on Wall Street. Well, we are back off of the record highs, a rare bit of weakness. It was led by tech yesterday. S&P futures, little change to slightly lower, slightly higher for NASDAQ as Russell 2000 futures move higher, probably thanks to lower bond yields. It was ASML that badly hurt this market. It is down again in the trade in the Netherlands. Again, its worst day since June 1998 after a weak earnings report. For the global bond market, it's being led by the UK. Rates are moving lower across the board. Inflation back below 2% in that region. You can see cable at the bottom of your screen falling around 130 because of that, but also lower oil prices helping this bond market too. We got some data yesterday. The New York Fed's latest survey of consumer expectations showed that debt delinquency expectations moved higher again. The mean probability of not being able to make a minimum debt payment over the next 3 months has risen to 14.2%. That is the highest since April 2020, at the height of the pandemic. Joining us now is Garrett Melson, portfolio strategist at Natixis. Garrett, I wanted to bring this specific piece of data to you because you are long discretionary stocks. How are you viewing the consumer at this moment when you have pieces of data like this, and again, data like that from the banks showing some strength?
Yeah, well, thanks for having me, Danny. You know, I think it's a story of a bifurcation, right? And I think what we hear quite a bit in a lot of the narratives is that there is some cracking going on with the consumer. And this has been a story we've been hearing for what seems like years at this point. But when you take a look at what actually drives consumption, yes, we do see some weakness at the bottom income cohorts, but that tends to only represent, less than 10% of the consumption basket. So it matters, but it matters at the margin. And when you look more broadly at the consumer, you continue to see a story where jobs remain pretty healthy, a labor market that, even if it has softened, remains pretty strong. Wage growth continues to normalize, but remains healthy. And as long as consumers have incomes to spend, you're seeing that consumption remains pretty well supported here. As the Fed continues to ease, you're probably going to start to see some of that consumer debt come down as prime adjusts lower. All of that, I think, continues to be supportive of the consumption backdrop. And discretionaries have been, quietly underperforming for quite some time here. If you look at it on an equal weighted basis, starting to perk up a little bit more recently.
Garrett, it still, though, is a market that's more concerned about the labor market than inflation. You saw that when we had CPI and claims out at the same time. Bostic yesterday was speaking, though, and said, I actually think we're going to see inflation be choppy, and I expect that we'll see employment stay robust. Even if it's a market that's concentrated on labor, is this a Fed that, after the strength of the previous reports, is still concentrated on inflation, maybe more so than weakness to come for this labor market?
Yeah, I think with some of the recent Fed speak, it's not surprising to hear a little bit of pushback and I guess suggestions that the committee is open to a pause. But at the end of the day, this is Powell's Fed. I think that's very clear from the decision to go 50 at the September meeting here. So it is still clearly, I think, a Fed that sees labor markets as kind of taking control of the mandate at this point. Now, maybe some of the data suggests that the balance of risk is not quite skewed as far towards the labor side of the mandate as maybe markets had thought coming into this over the last couple of weeks or into that September meeting. But I think at the end of the day, when you continue to see durable signs of inflation returning to trend, yes, it might be a little bit choppy to get there or back to target. But at the end of the day, the bigger risks are for inflation to remain skewed to the downside and unemployment to remain skewed to the upside. And I think that gives them enough cover to continue easing, even if it is a little bit more modest of a pace, and that ultimate destination is a little bit higher than we previously thought just a couple weeks ago.
But in the near term, Garrett, we are dealing with a fog of data, that's being impacted by strikes, by hurricanes. I was speaking with Andrew Hollenhorst of Citi last week, who basically said we won't understand any true trends for months, that it's going to take months for the fog to disappear. Garrett, what do you do in the meantime?
Exactly. And I think that factors into the balance of risks and how the Fed kind of feels out the right path for policy moving forward. You're going to have a lot of macro noise over the next couple months. You have the distortion from Boeing strikes. That's been a pretty important contributor to equipment investment over the last couple quarters here. And namely, the effects of the hurricane. So when you kind of factor these all together, add in the fact that you're continuing to see rates kind of hold back the housing market, you can find this story where there's a potential for an air pocket in some of the data with a lot of noise on top of that. And so ultimately, I think that skews the Fed towards being a little bit more cautious. And from my perspective, given that balance of risk, that still suggests that inflation is probably not a key concern, and we really need to be focused on the labor side of the mandate here. I think that's another reason to support why they'll continue to modestly recalibrate policy and just continue with 25 basis point cuts per meeting here.
For what it means for equity markets, having this confused macro signal, Savita Subramanian over at Bank of America says that it's muddled macro. Stock picking matters again. It's difficult just to buy an index. You need to look at idiosyncratic stories, Garrett, especially as we're entering earnings season. We're most of the way through the banks. How are you viewing individual opportunities versus investing in sector stories or at an index level?
Yeah, well, I think the story for this year has certainly been one of a pretty good stock picking environment. But even when you kind of peel back the layers, we've talked quite a bit about the Mag 7 and its contribution to performance, but the broader market has certainly seen an increase in participation over the last couple of months here, and that's certainly something we want to see. I would actually say that, yes, you have some of these downside risks. You have that potential for an air pocket in some of the data, put into some of those risks I mentioned, the fact that a lot of companies are basically hitting the pause button right now until after the election. So all of those are risks. But I think what you're seeing is that a lot of the data flow suggests that maybe those downside fears were a little bit overdone here. A lot of the labor market cooling is simply a story of normalization. And things are on a little bit more solid footing than we feared. So from that perspective, good news is good news because that continues to suggest that the economy is holding up. Revenues and earnings continue to be supported. And if we do start to see some weakness in data, I think that just means that the Fed's going to be stepping up a little bit more aggressively here. So it's kind of a heads I win, tails you lose dynamic here. And I think that's going to continue to be supportive of risk appetite and ultimately help to support the broader indices. So while I think it's a good environment for stock picking, I actually think it's a pretty good environment for maybe a rising tide dynamic. Yes, there's short-term risk with the election uncertainty, but beyond that, I think the macro backdrop is still very supportive. Growth's holding up. Labor markets are holding up. The Fed and global central banks are embarking on a synchronized easing cycle. And at the end of the day, I think that's going to continue to support upside earnings revisions.
Garrett, this was really excellent. Please come join us again. Garrett Melson of Natixis. Thanks for getting up early. This is Bloomberg.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Why should I want to invest in the pharmaceutical industry? Is it going to continue to grow as it did last year? And what about your own company? Do you think it's going to have good growth prospects over the next couple of years?
I think the reason to invest in the sector is the science. I mean, when you look again, if I go back into the history, for most of the last century, we were only giving people pills and small molecule drugs. Then we discovered that we had this whole world of biologics, and we could treat diseases with biologicals. More recently, we've discovered that we can reprogram your cells, we can edit the genome, we can use these RNA therapeutics to completely transform areas of medicine. Those technology areas are at their very nascent stage, and what we're going to find is they're going to open up whole new areas of growth from our business standpoint and a human health impact standpoint. We hope that as we work in our areas like cell therapy and RNA therapeutics, we will also be able to climb to a whole other level of market cap over time.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
It's your Bloomberg Brief, Danny Berger in New York. Morgan Stanley will be wrapping up the big bank earnings later this morning. That's after some strong results, but mixed reactions from its peers. Take a listen to what Goldman CEO David Solomon said yesterday on the earnings call.
We have deep, deep client relationships, clients who rely on us for a package of services, and that's not going away. Certainly in this environment, this is an environment that's filled with uncertainty. Their need to constantly be engaging and, repositioning and reshaping, continues to make them, very, very active on a broad global scale.
Solomon there hinting at the stock trading bonanza for Goldman Sachs and others. Joining us now is Octavio Morenzi, CEO and co-founder of Optimas. Octavio, always great to see you. So we had really strong trading results. Net interest income, for the most part, not as bad as feared, yet a muted response in Goldman shares and Bank of America shares, especially compared to JP Morgan the Friday before. What did you make of the results we've gotten so far?
Well, it was sifting through these financial results. I think in most cases, actually better than were expected. So the loss provisions they set aside in most cases were better. There was an improvement there. Net interest margins not deteriorating, and in some cases actually even improving. I think someone like Wells Fargo, I think, was a particularly interesting one, where they basically reduced their loss provisions and saw things actually improving, despite the fact that they have a very big exposure in terms of things like commercial real estate. So those, I think, were the interesting things. But I think what is most interesting about it is what it actually says about the broader U.S. economy, because the net charge-off rates and loss provisions and things of that sort remain quite muted, even on the most sensitive areas of those portfolios, which tends to be the credit cards. And so the first sign of trouble you see in the U.S. economy tends to be there in the credit card portfolios and the charge-offs there. And they remained very muted. We saw things varying between 3.8% and 4.2%. Now, that sounds like a lot to lose every year, but bear in mind, historically, we've seen things much, much higher. So that's inching up slightly, but still pretty low. So I think it speaks to the robustness of the U.S. consumer. I think the U.S. economy overall is looking really good. And the talk of a soft landing looks like a very, very soft landing, if a landing at all.
Oh, no, we're going to get into the landing definitions, aren't we, Octavio? Just park that to the side for a moment, because that's a whole other conversation. You did see, though, loss provisions raised for both JP Morgan and Bank of America. Are they doing it from a place of strength, Octavio, because they can, or because there are concerns for them on the horizon?
Well, the loss provisions they set aside is always a bit of an art more than a science, I think, in terms of how to make those determinations and how much they're going to put aside. But I think they're doing it from a position of strength, basically. So they've seen the underlying charge-offs not increase that much, but say, okay, we should put some more money away there. There might be some softening in the economy in our forecasts, and therefore we're going to put these loss provisions aside. If it doesn't come into being, we don't actually make those losses, well, we can reverse that and then reduce our provisions and have a nice boost to our net income. So I think we'll probably see that a bit later down the road. But the actual real losses on the portfolios, really people not repaying their debt, remains very, very low and very, very manageable. So that's a very encouraging sign. But so, yes, they're doing this from a position of strength, setting money aside for a rainy day, but I'm not sure it's absolutely necessary for them to do that at this stage.
Octavio, what did you make of Citi? Not even just the results themselves, but the reaction. They come out, again, equity trading is really strong for them. Pre-market shares are higher. And throughout the day, you end up getting a pretty vicious sell-off that ends in down 5%.
Well, as I was looking through the earnings that came out, we were sort of sifting through them and saying, what's happened here? I think you saw pretty flat revenues, expenses down slowly, somewhat of an increase in terms of loss provision. So overall, it was a bit disappointing, the results there. Couldn't really figure out why the market was rewarding Citi for these results. I don't say they were mediocre. They were somewhat lackluster, I think, overall. Very, very hard to say why in the pre-market it went up and then it got punished later on in the day when the markets were open. So I'm not sure why that particular thing occurred there. But I think if you look at Citigroup as a whole, they've been in sort of a restructuring exercise for the better part of a year now. The CEO, Jane Fraser, had announced basically taking out whole layers of management, restructuring things, reorganizing them, and taking away a lot of the redundant management layers that were within Citibank. And I would have expected to see a bigger impact in terms of cost savings at this stage in that transformation. So we saw a fairly tepid reduction of 2% overall in operating expenses, but you can achieve that very easily by just having a hiring freeze and just letting natural attrition run its course. So a 2% reduction in operating expenses is not what I would have hoped for Citibank. I would have expected to see greater dividends being paid from this massive restructuring exercise they've gone through. And I think the market looked at that and is a bit disappointed by that overall, that is not having its effect. Bear in mind, Citibank's stock price, Citigroup, has had a big run-up over the course of the past year, mainly on the back of the promise of this big restructuring effort that's underway.
Octavio, I got to squeeze this in. Where does this all set the bar for Morgan Stanley when it reports in a little less than 2 hours' time?
Well, I think they're going to do really well. So if you look at the businesses that Morgan Stanley is in equities trading, in fixed income trading, in asset management, wealth management, all the results at the other institutions were pretty strong there, particularly in equities trading, where they've got a nice franchise. So that should do fairly well, I think, overall. So I'm expecting to see do really well, strong top-line growth. I think the real question is, what are they happening on the expense side? Are they able to contain and control their expenses? We saw Goldman Sachs do a very good job there. I would expect to see that replicated at Morgan Stanley, so we shouldn't see a big boost. I would say over a 50% increase in terms of their net income for the quarter compared to last year. So I'm expecting good things from Morgan Stanley later on today.
Octavio, wonderful to get your thoughts. Thank you for joining Octavio Morenzi of Oppimas. And tune in to our interview with Morgan Stanley CEO Ted Pick. That'll be at 10:30 a.m. on Bloomberg's Open Interest. We're also counting down to the U.S. presidential election, now less than 3 weeks away. Both candidates continue to highlight their economic plans as the main focus of this election and their discussions. Former President Trump sat down with Bloomberg's John Micklethwait at the Economic Club of Chicago. Take a listen.
We're all about growth. We're going to bring companies back to our country. We're going to lower taxes still further for companies that are going to make their product in the USA. We're going to protect those companies with strong tariffs, because I'm a believer in tariffs.
That was Bloomberg's exclusive interview with the Republican presidential nominee Donald Trump in partnership with the Economic Club of Chicago. Joining us for a look into the economic futures under Trump and Harris is Anna Wong, chief U.S. economist of Bloomberg Economics. Anna, thanks for joining us. I know you were up yesterday also keeping track of that conversation. It's two very different worlds that these candidates are proposing. For Trump, it's a lower corporate tax rate to 15%. For Harris, it's a higher corporate tax rate to 28%. Just how big of a gulf are we talking about the economic future for America under either candidate?
Yeah, so Trump is all about tax cuts, except when it comes to tariff. A tariff increase would be a form of tax increase. Harris campaign, aside from the corporate tax hike that she's proposing, so she's proposing to raise the corporate tax rate from 21% to 28%. She's also implicitly proposing to raise taxes on the upper income. So if TICTA were to expire at the end of 2025, the marginal tax rates of the top income would go back to 39.6 from 37%. So effectively, tax rates would be increased under Harris. And so, whereas under Trump, if he were to be able to make all the personal tax cuts under TICTA permanent, then all Americans will see their marginal tax rates remain at where they are. Another thing that's different about the two candidates, of course, is for Harris. Harris supports raising the tax rate on unrealized capital gains for the wealthy to 25%. That would be quite substantial because the wealthy are not taxed on the unrealized capitals right now. Furthermore, another big difference is child tax credit. Harris proposed to increase the child tax credit to $3,600 per child and even $6,000 for a newborn, whereas under TICTA, if TICTA were to expire, it would have child tax credit would go down from the current $2,000 to $1,000. So that's another big difference there.
There's so many things, though, of course, that are hard to figure out because they'll need congressional approval and things like that. But Trump really doubling down, not just on tariffs yesterday with John Micklethwait, but continued to drive this message that it is growth, calling the U.S. a developing market, that it needs growth-like policies. How do you understand how the policies will actually impact growth?
Yeah, so I see the holistic nature of Trump's tax policy as very similar to his first term, which is he thinks that by relying on tax cuts, that pro-growth, that growth-enhancing impulse would more than offset the growth-reducing impulse of the increase in tariffs. So our model suggests that all the tax cuts would generate about 0.3% boost to GDP by 2028, whereas Harris policies, if she were to be able to pass all of them, would be reducing growth by 0.1% of GDP by 2028. That said, the tariff increase under Trump will more than offset that 0.3 percentage boost to GDP growth from the tax decrease by our estimation. Also, another factor to consider is how much of these proposals are likely going to be passed. So in consultation with our colleagues at the government affairs side, we thought that the plausible policies would basically water down both candidates' tax policies to be about roughly the same. And ultimately, the GDP impact of Trump's plausible tax policy would only boost growth by 0.1% by 2028, whereas Harris' plausible policy would be essentially left GDP growth unimpacted.
When it comes to things like his tariff policy, Adam Posen has long said that it could even mean that you see a Fed that hikes next year. Anna, what have your models shown about possible inflationary regimes under the candidates?
Yes, so most economic models would say that Harris would boost inflation. So our models thinks that it would be, if all of Trump's tariffs were to pass, which is 60% tariffs on China and 20% the rest of the world, that would boost inflation by 1%. It could be 1 percentage point, more than 1 percentage point in the first 2 years. But that said, I think Trump did make a valid point in pointing out to how in his first administration, his tariffs didn't generate a big inflation impact. And that's because the economy responds to tariffs in two ways. One, either firms can pass through those tariffs to final prices, which generate inflation, or they could just reduce profit. And we saw the latter in the first Trump administration.
Anna, thank you so much for your insight. Anna Wong of Bloomberg Economics All right, coming up, we're going to set up your trading day, Morgan Stanley results, and we have an exclusive interview with Druckenmiller. All that to come. This is Bloomberg.
Countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
There is this real momentum from Wall Street.
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
Welcome back to Bloomberg Brief. I'm Danny Berger in New York. Let's get you set up for your trading day on this Wednesday. Morgan Stanley will be reporting its third quarter earnings before the bell. And then tune in to our interview with the CEO, Ted Pick, at 10:30 a.m. Eastern. A lot of important conversations. We'll also be speaking with the Duquesne founder, Stanley Druckenmiller. That is at 12 p.m. Okay, some of your individual movers this morning. Intel falling nearly 3% in association backed by Cyberspace Administration of China suggests a check on Intel products due to cybersecurity risks. Interactive Brokers down nearly 5%, extending its declines after a miss on its earnings. Finally, Cisco there, Citi upgrading it to a buy, citing that AI is benefiting the firm's top line. Quite a different fortune for different chip makers. This morning, you're also seeing bond yields come in, led by the UK after inflation coming in below 2%, down 8 basis points. Your 10-year yield down 2.7. Okay, that's it for your brief surveillance. They'll take things from here.
As we spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
The market is underestimating the strength of the U.S. consumer.
I think the consumer is as strong as it's been.
As long as the consumer is spending, we will continue having a strong economy.
The evidence suggests it's an economy that's pretty resilient.
It's really the U.S. that is driving the world economy right now.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Let's get your trading day started live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now, snapping a two-day winning streak on the S&P 500, pulling back from all-time highs in yesterday's session and looking for a firmer footing this morning, going into Morgan Stanley numbers at 7:30 Eastern Time. Futures barely positive. The single name we're talking about, ASML, the company that makes the machines that makes your chips. Down hard yesterday, down again today by 4%. Earnings released on accident yesterday, and those earnings, an accident waiting to happen. Bramo, a major downside surprise.
Yeah, they booked only about half the orders that analysts had expected. The shares plunged the most in 26 years. And a real question here about why. Is this just the differential between everything AI related and everything else? The idea of the industrial chips, and we see this with Intel? Or does this have to do with China, which accounts for almost half of all of ASML sales?
So let's go to China. LVMH, absolutely dreadful. Check out this move over in Paris trading. We're down by 4%. And sales are down too. Fashion and leather goods sales dropping for the first time since the pandemic. And the quote from the CFO, take a listen to this, at a time when everyone's getting all balled up about the prospects for China. Consumer confidence in mainland China today is back in line with the all-time low reached during COVID.
Well, that also goes to what Citigroup put out, and they sent individuals to China looking in a mall, and they came back with saying there's no improvement of luxury consumption after the recent macro policy pivot. Not just is it bad in China when it comes to LVMH, and there's some 75 brands across clothing, jewelry, hotels, spirits, but also in Japan. They're not seeing, because of the higher yen for the Chinese consumers, they're not seeing them spend as much there. Also in the US and Europe. So luxury is not doing well right now.
So there are two questions here, and just to point out, this is the first decline for LVMH's sales going back to the pandemic. Two questions here. How much is this that China's economy is actually doing worse than people think? Or how much is it that China's economy has gotten that much more isolated from the rest of the world, where their benefit and their gain and their consumer appetite doesn't go to ex-China goods and materials?
Yes, both. I think it's got to be both, and that's a big, big problem. Even if we do get a big stimulus package out of the Chinese officials, how much will it boost the rest of the world? And to your point, perhaps not by much.
And it's very difficult to understand the policy landscape, thinking about the Netherlands with ASML, this idea that they might be barred from selling to China, at the same time that China will be telling its own companies and individuals, don't buy from them. So there is an institutional structural fissure being put in place at the same time that companies are saying, what am I going to do?
ASML CFO was very honest about what they see in China. They're calling it now more normalized percentage in our order book. So basically they're saying they think next year it's going to come around 20% of total revenue. In June, when they talked about it, it was 49% of its sales. So these hard cold numbers basically show you that is still not the avenue it once was for a lot of these major companies.
Two European players right now in focus for us all, ASML and LVMH. Looking ahead to Morgan Stanley numbers, 7:30 Eastern Time. Then looking ahead to retail sales tomorrow, 8:30 Eastern. That's the big data point of the week. Equity futures right now on the S&P 500, barely positive on the S&P. In the bond market, a bit of a rally. Yields are down by 3 basis points, just about holding on to 4% on a 10-year. An even bigger rally over in the UK. Lisa, speaking of downside surprises, CPI in the United Kingdom, a little bit softer than expected.
Basically, yet another example in Europe of why not cut, right? I mean, we've already said that with the ECB tomorrow, which is probably going to cut by 25 basis points. But now all of a sudden, the Bank of England also seeing seeing the potential for why not cut, given the fact that CPI came in below expectations, and they're facing off with the potential of growth also coming in soft.
We've got to wait for that budget from the UK as well, from the British Prime Minister, from the Labour government, and then November 7th. November 7th, Bank of England rate decision, the same day as the Federal Reserve. Coming up on this programme, Julian Emmanuel of Evercore, with stocks coming off all-time highs. Elias Galou of Bank of America on a bullish global fund manager survey. And Stephen Trent of Citi as United Airlines delivers better than expected earnings. We begin this hour with equities pulling back from all-time highs following a sell-off in the chip makers. Julian Emmanuel of Evercore staying long big tech and writing the following: we remain fully invested in sectors and themes which are proven winners in the year after the Fed begins a rate-cutting cycle, including information technology. Julian joins us now for more. Julian, good morning.
Good morning.
I know we can't do single names with you, but what about one single name? What did you think of ASML? What do you think it means for the broader sector, for chip makers and tech stocks more broadly?
Well, look, again, you go back to this entire bull market cycle has been led by semiconductors in one way or another. Obviously, the AI theme, the primary driver. But it is definitely a question that opens up sort of the issue about, why China did what it did several weeks ago and what the efficacy is ultimately going to be. And I think it also calls into the fact that this is one of these times where, you're seeing the weakness in China. You're seeing, the ECB is going to cut again this week. Europe is certainly not going gangbusters, and the U.S. really is, again, the isolated island of global growth right now. And that's not really healthy on balance.
It raises a big question about how we should process incoming information over the next month or so when we hear from more companies with greater exposure to the story out of China. How would you process that incoming information?
Well, look, the equity price reaction in China over the last several weeks tells you that there is at least a belief that something may change. It also tells you how incredibly underweight global fund managers are to the China theme. And look, this is the government has set a bar and an expectation, and it's going to have to deliver. And I think that the other question will be, what the election outcome is in the United States. And if you get a Trump presidency, which is clearly going to be at least incrementally, if not greater than incrementally, more difficult for China, what is the policy response to that?
You see a lot of potential volatility coming down the pike. You could see a scenario for 5,200, or you could see a scenario for 6,700, depending on a lot of different outcomes. We talked about the Bank of America Fund Manager Survey, and we're going to be speaking with them in just a bit. They say there are three prongs to the incredible bullishness that's been really in the market right now. One of them is the belief in a soft landing globally. One of them is the anticipation of Fed rate cuts. And one of them is that China policy stimulus that seems to be supporting some of this optimism. Which of the three do you think is most fragile?
I would say on balance, the China policy, again, because we've heard what they said they might do. We saw the reaction in shares. But at the end of the day, you can argue that the structural problems in China are structural and take multi-years to work themselves out. In a lot of ways, it's almost the kind of negativity that you saw in 1982 in the U.S. when you came off of a decade of, really subdued investor confidence, a very cautious consumer, and incredibly horrible share price reactions.
Is that going to be enough to take us to the 5,200 projection rather than the 6,500 projection that you have for the S&P?
Well, to be clear, our year-end price target of 6,000, again, because of the difference in what could be contested versus an uncontested election result here, united versus divided government. Investors very clearly prefer a divided government outcome. But, you think about it, and an uncontested outcome in this environment where we've already seen the start of a year-end performance chase because the Fed green-lighted that on September the 18th with a 50 basis point cut, that's your path to what we would term a melt-up. But conversely, if you get the kind of contested election outcome that you got, say, in the hanging Chads year of 2000, when the Yankees and the Mets last met in the World Series.
And the Yankees won.
All right. Seriously, you're going to make
What
this
if you
antagonistic?
History rhymes, but doesn't always repeat.
Okay, let's go to your gaming the Game of Thrones, back to this idea of what's going on with the election. What does this mean for the stock market? When you say contested, uncontested, does it matter who the president is, or just the fact that we were able to sail through this?
I think, again, this preference for divided government, given the acrimony in the country right now and the sharp policy differences and the idea that investors don't want the tail ends of either candidate's policies, is really the most important thing long term. Short term, again, it is a question of, we do not want to go through this questioning the freeness, fairness of elections and that process again, because that's a page that does need to be turned.
When you look at what the market wants, is this almost a self-fulfilling prophecy? Investors come on constantly and they say, our base case is Goldilocks, gridlock, that's Goldilocks. Isn't that what they want because that's good for the market, but are they actually looking at the polling data accurately?
I think there's an element of hope in all of this. I mean, let's get serious. Essentially, a week after Harris became the nominee, this thing has been a toss-up. It is a toss-up, all over the map. And in fact, if you look at the odds right now, the concept of both chambers of Congress flipping in the other direction, regardless of who the president is literally unprecedented in history.
Can we just finish up with a guide for where sentiment is right now? And I'm going to read two very different quotes, two very different views. HSBC, sentiment and positioning is still neutral. Max Kender's been talking about poking the bears. He thinks people aren't bullish enough. Your old shop, BTIG, Jonathan Krinsky had this to say: fear of downside has left the building and fear of missing upside is front and center. Where's sentiment? How can we have two completely different views about positioning and sentiment right now from two completely different banks?
Well, both the Bulls and the Bears are holding their desk, essentially, in front of the election. But what we would say is, coming into September, when we all know September has a history of being a negative month, the first week or so you had the flush out, and you had position having gotten light. But as I said, after that 50 basis point cut, you have regrossed. I would say sentiment is probably not overly enthusiastic, but certainly bordering there. And if we were to see, despite all this negative news out of the traditional semi-manufacturers, if you saw the AI theme lead further upside, sentiment could get enthusiastic very quickly.
This was a nice 8-minute conversation without talking about the Federal Reserve. So let's talk about the Federal Reserve. One final question. Is it the easiest job in Washington, D.C. to be the Fed chair? And would it be better if we just flipped a coin to make a decision?
We're very much in the camp that the Fed should be an independent entity. It is not the easiest job. I mean, if you think about the fighting the pandemic, then fighting an inflation that nobody saw coming, and here we are with arguably, not even arguably, the world's strongest economy, and a recession that people have been looking for 2 years that has no signs of occurring. That's not an easy job, and it's been done pretty darn well.
Very diplomatic. Gillian, good to see you. Thank you, sir.
Thank you.
Gillian Manuel of Evercore there. Equity futures on the S&P 500, totally unchanged. Just remember, Morgan Stanley earnings coming out a little bit later this morning. Retail sales out tomorrow morning. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. UK inflation slipped below the Bank of England's 2% target for the first time in 3.5 years. Consumer prices rose 1.7% in September compared with the year earlier. Traders are now betting on back-to-back rate cuts at the BOE's November and December decisions, having previously favored only one reduction. Shares of LVMH slumping in the Paris trade, down more than 4%. The luxury goods retailer reported an unexpected drop in third quarter sales, warned of an uncertain economic and geopolitical environment. It was the first decline in sales since the COVID-19 pandemic, all driven by slumping Chinese demand. A shareholder of 7-Eleven parent company 7 & I is urging the company to return to the negotiating table with Canada's Couche-Tard. The investor said that 7 & I's recent announcement that it was restructuring the company was designed to thwart the acquisition. It had proposed to split its business in half. So far, 7 & I's shares remain below Couche-Tard's proposed price, suggesting market skepticism over a possible deal. And that's your brief, John.
Danny, thank you. More from Danny in about 30 minutes' time. Up next on the program, the Tariff Man on tour.
To me, the most beautiful word in the dictionary is tariff. And it's my favorite word. We're going to have thousands of companies coming into this country. We're going to protect those companies with strong tariffs because I'm a believer in tariffs.
A lively debate over in Chicago. We'll get you some of the details up next. Live from New York City this morning. Good morning.
Was going to keep reading World Cup. This is a 3
as the economic picture,
covering the intersections of Hollywood, Silicon Valley, and beyond.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching The Close. Welcome to Balance of Power.
This is Bloomberg.
Just a little bit of calm after a storm from the chip makers yesterday. Equity futures totally unchanged on the S&P 500. Bit of a change over at UBS. Jonathan Golub, new year-end target for 24-25. Target 5850 year-end, 6400 year-end next year. Just a nudge higher from the team over at UBS. In the bond market, yields a little bit lower. We're down 2 or 3 basis points. The 10-year just about holding on to 4%. Under surveillance this morning, the Tariff Man on tour.
To me, the most beautiful word in the dictionary is tariff. And it's my favorite word. We're going to have thousands of companies coming into this country. We're going to protect those companies with strong tariffs because I'm a believer in tariffs. I brought in with tariffs, 2,000% tariff, the highest tariff in history. We're going to put tariffs on them, the tariffs. I put tariffs on China. I put tariffs on South Korea, the threat of tariffs. You're going to pay 100% tariff.
I think you get the picture. Here's the latest this morning. Donald Trump defending his plan to overhaul the U.S. economy through a series of steep tariff hikes and gaining more direct influence over the Federal Reserve. The Republican nominee dismissing the notion that the policies could have a negative impact on the economy and for U.S. consumers. Bloomberg's Katie Dines joins us now from the nation's capital for more. Katie, just how popular is that position?
Well, it depends on who you're talking to. If you're talking to most economists, the prevailing wisdom is that this would be inflationary policy. If you're talking to blue-collar voters in some of the key swing states that ultimately will decide this election, this is a little bit more of a popular idea. These notions of populism is protecting American manufacturers and making more things in America is something that resonates with many of these individuals who have found themselves supportive of Donald Trump's policies, many of them going back to 2016. Now, when Donald Trump was pushed on this idea that this could ultimately lead to cost for some of these very same voters I'm talking about going higher, he said no, because all you have to do is make your products in America and then there will not be a tariff. To actually quote him directly, he said, you make the tariff so high, so horrible, so obnoxious that they'll come right away, suggesting companies will come and start making goods in the U.S. I think we all know that supply chains don't necessarily reorient themselves that quickly. Factories do not build themselves overnight, and yet that is what he seems to be suggesting, that he's just going to force companies to come here in the U.S. through these protectionist policies.
Kayleigh, maybe not as aggressive as the former president, but the Biden administration has kept tariffs on that Trump first introduced. Is that working for them or not in terms of the campaign?
Well, it's an excellent point, Anne-Marie, and Donald Trump did point that out yesterday, that many of the tariffs, in fact, almost all of them that he put into place during his first administration has been left intact and perhaps even expanded in some instances under this current administration. Most people I speak with would say the differentiation here is, yes, you are likely to still see protectionist policy. You are likely to still see export controls going into place when it comes to China to try to limit their ability to develop critical technologies. The difference is the targeting. What Donald Trump is suggesting is blanket tariffs across the board versus things that could be more deliberate in the areas in which they are actually implemented, and that seems to be one key differentiation. All that said, we haven't heard as much about tariffs from Kamala Harris as we have from Donald Trump. I think it's safe to say it is not her favorite word in the dictionary.
The former president also said that he's going to be watching on election night. What he finds decisive is #1 Pennsylvania, and that's where Kamala Harris is today, and she's actually going to be speaking to Republicans, correct?
Yeah, she's going to be doing an interview on Fox with Brett Baier. This is part of a strategy we're seeing on her part in terms of media to reach out to voters that aren't yet with her, that she would like to see more support from, including Republicans. We have seen her trying to create this permission structure, if you will, for Republicans to cast a vote for her over Donald Trump. You've certainly seen that in, for example, the endorsement of Liz Cheney and the campaigning alongside her we saw earlier this month. And it's not just about reaching out to Republicans as well as about trying to shore up other parts of what has traditionally been the Democratic base. Yesterday, she was on with Charlemagne the God, trying to amp up her support among black male voters specifically, as we have seen polling, including recently from the New York Times and Siena, that shows, yes, she has improved her standing among black voters compared to where Biden was when he left the race. She is still not yet at the levels of black voter support we saw from Biden in 2020 when he was able to garner 90% of the black vote in what was a very tight election. And in an election that seems to be getting tighter and with margins that are likely to still be very small, that 10% differential, she has about 80% right now, could make a big difference.
Kayleigh, how many minds really are undecided? How much is this just a turnout game and trying to ignite some sort of enthusiasm in certain groups?
The basket of people yet to make up their mind is incredibly small, Lisa, and probably shrinking every day. As I would remind everyone, yes, we are less than 3 weeks out now from the election on November 5th, but the election day is one thing. The election already is underway. Voting has started in a number of states early, including key battlegrounds like Georgia, which began early voting yesterday and sent a record for turnout of more than 250,000 people showing up on the first day. So it is going to be about the game of driving people out to vote, and that is why money still matters here at this stage of the race. Yes, most of the ad buys are in, but having access to a larger war chest to be paying people to go out and knock on doors and actually do that driving force of getting people to the polls is what's going to be key here. It was also raised to me yesterday as we consider Donald Trump's remarks in Chicago, maybe more oriented toward the donor class. In some instances, the money is also going to matter after the election, as we've already seen so much litigation leading up to it, potentially could see very litigious activity in the aftermath if these results are contested, and it's going to take money to fight those fights as well. So both for turnout and then ultimately in the decision-making, if you will, around what the actual vote turns out to be, money could be a big factor.
Kaylee, you mentioned yesterday's interview with Donald Trump, and he did also mention the early voting, saying that signs are that he's capturing a significant majority of those votes. What kind of visibility do we have into that, Kaylee?
Well, Donald Trump has had mixed messaging on early voting, frankly, Lisa. We have seen this over the past 2 election cycles. At one point in the same speech, he was encouraging people to go out and vote early and then called early voting stupid. We've actually seen a phenomenon, and especially in states like Pennsylvania, which, as Anne-Marie mentioned, he said is the one to watch, could ultimately be the deciding factor in this election with its 19 electoral votes. They can't begin counting those early mail-in absentee ballots until the morning of Election Day. And if it is skewed more democratically, those who are mailing in versus those who are not, given some of the rhetoric we have heard from Donald Trump and those close to him, we could see early in the count a skewed result toward Donald Trump versus what ultimately the final tally will be. So it's certainly a factor, but you are seeing a more concerted effort now to drive people to the polls early on all sides. And that goes for down ballot as well. If you look at the Arizona Senate race, for example, Carrie Lake, who was very against early voting, has actually already cast a vote early for herself and is now pushing it. So there's been a lot of changing narratives around this.
Some big changes. Katie, appreciate the update. As always, Katie Lyons from Washington, D.C. You can catch Katie alongside Joe Matthew at 12 and 5 p.m. Eastern Time on Balance of Power. Let's talk about these interviews. These are risks the Harris campaign would not have even thought about, wouldn't have touched a month ago. Fox News, Brett is the real deal when it comes to conversations like this. So this is a risk they just wouldn't have taken even a few weeks back.
And he's going to get 30 minutes. And he's talked about this interview and the lead up to it, saying he thinks it's enough time to really push her on some answers that he thinks the electorate is looking for. Look, they get half the eyeballs in the United States. And if you want to win those that are potentially still undecided, you have to go there. And what Harris is doing today, she's going to have a pit stop where George Washington famously crossed the Delaware River during the Revolutionary War. She is going after Republicans who potentially don't like the former president, and that is why she is sitting down with Bret Baier.
What strikes me is when she first entered the race, which was not that long ago, she was really the anti-Trump, and she was the candidate who is not going to be Trump.
Sure.
It has gotten to the point where every candidate who has gone against Trump has to realize they have to do more than that, which is the reason why a lot of these interviews are taking place.
The biggest challenge for her right now, Lisa, it's not just explaining the difference between her and Trump. I think at this point, that's pretty obvious. It's explaining the difference between her and Joe Biden, the President of the United States. When asked repeatedly on the campaign trail, they still haven't come up with a good answer for this. And I imagine Fox is going to repeat that question a little bit later.
They struggle with it, and that's difficult because then Trump can cast her as the incumbent. And the top 2 issues of this campaign still remain in his favor, the economy and immigration.
Up next on the program, we'll talk about the economy and financial markets. Bank of America out with a bullish global fund manager survey. That's next. This is Bloomberg.
the Vivian Tom clientele.
Yeah, power women, like the dragon women. They're lawyers, they're CEOs, they're all important decision makers, women in the world.
Why do you position your products for this group of women?
When I started, designing, I always want to do something that is empower women.
When you take a look at your store, there is something for everyone. Take a look at the T-shirt, for example.
My customer growing, like 30 years already, so they become more powerful. I also want to grow my Gen Z audience too, They are like in the 20s, so it's a more affordable price for them. And then, my powerful woman's daughter wearing their mom's dresses, and they feel that the power, the energy. So now they come back to the store and they buy more.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Ton of bullishness hitting a bit of a wall in yesterday's session. Equities right now on the S&P 500 totally unchanged. Snapped a two-day winning streak on the S&P in yesterday's session. Financials held pretty steady, supported by some pretty decent earnings. Look out for Morgan Stanley a little bit later. But the losses were led by tech and energy. Thank you ASML and thank you oil. And with that move in oil, we've got to bid back into this bond market, switch up the board and get to fixed income. The 10-year Treasury just about holding on to 4%. The 10-year this morning, Lisa, down 2 basis points.
It has to do with disinflation across the board and not necessarily some sort of inflationary pressure coming from the oil patch. I do wonder, people talk about the U.S. being truly exceptional. How much the U.S. is divorced from what's going on in the United Kingdom, in the Euro region, where suddenly almost deflation is a new concern, a renewed concern, I should say, for the first time since pre-pandemic.
So turn to foreign exchange. We'll talk about the UK. Pound sterling looks like this morning. The pound against the US dollar, 130.27. Weaker by about 1/3 of 1%. Inflation coming in beneath the target of the Bank of England and beneath estimates this morning as well. On the headline read, cause a different picture, but headline inflation starting to improve, opening the door potentially for an interest rate reduction from the Bank of England on November 7th. And likely maybe also across the channel, looking at the continent, maybe from the ECB this week as well.
Yeah, the likelihood of a 25 basis point rate cut tomorrow is very high in markets. Key question continues to be what's the path and how much does that diverge from what we're seeing in the U.S.? Just to put some numbers on what they saw in the U.K., consumer prices rose 1.7% in September. That is below that 2% goal and below the 1.9% expected by analysts. How much are we seeing a return to the old trend? And that, I think, is something that a lot of people are grappling with, where remember the time when central banks actually were trying to encourage inflation, trying to generate it to prevent a lost decade akin to what we saw in Japan?
That was a different time. Pound sterling, 130.26. Yield to lower at the front end of the curve in a gilt market. The 2-year down by close to 9 basis points. Under surveillance this morning, ASML shares plunging the most in 26 years after disappointing Q3 earnings. The chipmaker booking only about half the orders analysts had expected and lowering its guidance for 2025. TSMC is set to report earnings tomorrow. Now, this is a question that is impossible to answer, but it is worth exploring. If they hadn't released these on accident, we still don't know what happened. If they had have released these and you got that accompanying commentary, you got that nice call afterwards to explain this big plunge in orders relative to expectations, do you think we would have had the move that we saw in yesterday's session?
I guess we'll have to know after the call, after that nice presentation. There was some speculation that this was almost deliberate. Just rip off the Band-Aid, get it out there, see what happens. Honestly, there are so many question marks about this. How much is this the fissure that we're seeing between AI and what we're seeing in Intel with respect to automotive, industrial, iPhones, et cetera, that those chips are having more of a problem than, say, the NVIDIAs of the world, which continue to be dominant. The China question is so difficult. How do you deal with a country that is so deeply political in terms of some of the policies around it, as well as a lack of visibility of whether consumers can buy in China and then what they will buy?
The geopolitics is very challenging for some of these companies when you look at export controls and even what the Dutch government as well wants to do, signing up with the United States and the destination of travel is getting only worse, not better, even regardless whether or not it's as aggressive as a former President Donald Trump and his views on China, or potentially Vice President Kamala Harris going to the White House. But whether or not it was deliberate or not, Cantor Fitzgerald says we could debate that. Clearly, disappointing.
Two very different issues. They're connected, but two different issues, so let's break them up. You've got the cyclical weakness in China's economy. We'll talk about that with regards to LVMH in just a moment. And then you've got the policy issues down in Washington, D.C. And I think speaking to that story almost perfectly is this one. Sources telling us here at Bloomberg that Qualcomm will likely wait until after the U.S. presidential election to decide whether to pursue an offer to buy Intel, the company looking for clarity on the antitrust landscape and America's relationship with China.
So I'm not surprised when I see this. Why would you make any massive move in a company when potentially the direction of travel may be the same but more nuanced when it comes to antitrust, when it comes to how you view China? Also, though, we should note, after the election may help Qualcomm. Intel report third quarter earnings later this month. So basically, if they're so bad, the share price falls, maybe they can get a better deal on this tie-up.
Oh, so you think that this is just a pure financial thing, that their shares are going to tank and then they're going to be the white knight to come in? Is that right?
Well, I just think it might help them and they can use the election as an easy excuse.
Yeah, well, honestly, I think that the bottom line is, why would anyone make a big move before the election with a major industrial company? Because you would just end up being on the campaign trail. And that's what we saw, certainly with U.S. Steel.
Julian Emmanuel was just on this program, and he said bulls and bears are both holding on to the desk. You have to imagine C-suite executives are doing the same.
Do we really think the antitrust environment's going to shift that much under Trump versus Harris?
It depends if some of the donors on both sides can get in either of these individuals' heads, and we can ask Howard Lutnick about that.
I think you raise an important point. The market environment could shift markedly if it's Harris versus Trump. If it's Trump when it comes to China, whether it's reality or just perception, in the immediate aftermath of that election, perception will matter a whole lot more. And you'd have to imagine China gets sold, and gets sold pretty hard.
Which raises a question of whether people are lining up to potentially buy on the cheap. I mean, you have to wonder what actually is a threat and what actually a negotiating tool and what actually is something that is actually going to go into effect. We don't understand this. So are you really betting on sentiment shifts, or are you betting on reality shifts? Two different things.
I promised you an update on LVMH, so here it is. Shares dropping over in Paris, France, after sales of fashion and leather goods fell for the first time since the pandemic. The company citing slowing demand in China, organic sales in that region falling 16%, and the commentary from leadership, pretty awful.
Commentary was this: most of our markets currently face economic challenges, including mainland China. This is coming from the CFO. And they go on to say that basically consumer confidence in China is back in line with all-time low during COVID, when no one was going out and spending on luxury goods. That's how bad China is right now, even after we just had the stimulus measures from the Chinese officials.
Well, this is precisely why we had a very specific question when it came to the stimulus measures, and Lisa, you talked about it repeatedly. Where are the incentives for consumption? Just got a little bit, not enough.
Yeah, and just in terms of whether it's domestic or international, take it a step further, are we underestimating the weakness the Chinese authorities saw currently in their economy that prompted this type of response?
LVMH down by about 4%. Here's an update on the Bank of America Global Fund Manager Survey. It captures a big bullish shift in investor sentiment, showing the biggest jump in investor optimism since June 2020 and the largest jump in global growth expectations since May of the same year. To dig deeper into the results, into the survey, Elias Galou of Bank of America Securities joins us now for more. Elias, welcome to the program, sir. This is bullish. My first question to you, is it a little bit too bullish?
Hi, John. Look, I mean, this was really a global fund manager survey for the books. As you just said, you know, one of the biggest rise ever in global growth expectation. Look, this is a series that goes back all the way to 1994, and we saw, in fact, the fifth largest monthly jump in growth expectation in the past 30 years. So, yes, definitely a bullish survey, and for the first time in the past 3 years, positioning is also equally bullish. And I would say that, yes, the bulls are very much in control and have clearly led the charge in the past month.
Elias, John pointed to this before, this idea that Max Kettner over at HSBC actually sees pretty neutral positioning, and you're talking about pretty bullish positioning. Which is it?
You just need to look at a few different metrics across the Global Fund Manager Survey to just see bullishness is very much spread across the different asset classes. The most important, I would say, is the FMS cash level. Again, a series that goes back all the way to the late 20th century. And that FMS cash level dropped below 4% to 3.9% for the first time since June 2021. We use it as a contrarian indicator when investors are under-invested in the market, hence the cash level above 5%, we think that you should buy the market, and when it drops below 4%, we think you should sell the market. And at this stage, our FMS cash rule says that at this juncture, positioning is becoming a headwind. You also look at the cross-asset allocation. Equities allocation rose to net 31% overweight, and that's the largest one-month jump in equity exposure since November 2020. On the other hand, we saw a big decline in bond allocation. In fact, the largest one-month decline in bond allocation that we ever recorded, and the velocity of the rotation was also quite exceptional across markets. EM equities were the big winners with a 20-point rise in exposure to EM stock allocation, and that's really related to the China stimulus.
That's what I was going to ask. Was it really just the China stimulus that ignited this rotation, this unleashing of truly bullish spirits, or is it a combination of things?
It is definitely the China stimulus, but it's really the combination of three factors. Number one is that the conviction regarding global soft landing remains very much intact. 76% of FMS investors still believe the global economy will experience a soft landing. Note that the balance of risk has shifted to the upside because now the alternative scenario is no more hard landing, it's no landing. The second big reason, Lisa, is related to a big Fed cut expectation. FMS investors expect roughly 160 bips of cuts from the Federal Reserve in the next 12 months. That's pretty much in line with market expectation. And lastly, of course, the China stimulus, which really is seen as a game changer because when you and I met a month ago, China growth expectation had hit a 3-year low. Fast forward to today, they're now the highest they've been since April 23.
If you're one of those contrarians taking on the hard landing or no landing scenario, what does that mean for trades these individuals, these investors want to put on?
Yes, definitely. Who are the contrarians today? Those that would believe hard landing is their main scenario, and also those that would expect a no landing to happen in 2025. But if you are a hard landing believer, then definitely you should go long the 30-year treasury, you should pivot into defensives, you should pivot into cash, and you should really slash your allocation to equities and risk assets in general.
Elias, I want to get your thoughts on what are investors, given how bullish they are, what are they nervous about?
We always ask in the FMS the main tail risk according to investors, and this month it was a geopolitical conflict. They are still a little bit worried about inflation, but definitely less worried about a US economic hard landing. So yes, geopolitical conflict. And I would say, on the other hand, what would really scare investors is that if central banks do not deliver the big easing that they are expecting. A month ago, we said that investors were nervous bulls. Now they have just become bulls that are leading the charge. And it would definitely still be about geopolitics and about inflation.
Elias, you can see that bullish shift big time in the Fund Manager Survey. Appreciate an update from you, as always, sir. Elias Kalou there of Bank of America Securities on the big bullish shift in the Bank of America Global Fund Manager Survey. This ain't bullish. It comes from Stellantis to halt production in some Italian plants in November. This has been an ongoing saga for production, particularly in Italy, where they'd already suspended production of the poorly selling electric Fiat 500 in Turin. I've got some stats for you for production in Italian plants over at Stellantis for the first 9 months of the year, down 41% from last year. That's below the depths back in 2020. And if you pick out Turin, and anyone who knows Stellantis, particularly Fiat, that's the home of Fiat. Production there slumping 68% in the first 9 months of this year. So holding production after seeing numbers like that for the first 9 months of this year, hardly surprising.
Yeah, given the fact that there still is this overcapacity that they're trying to counter and a lot of cost cutting that they may have to do, this just highlights how we're talking about extreme bullishness, and yet there are pockets of weakness that are structural and cyclical, like the auto sector, which is a reason why a lot of people are looking specifically, even though they are pretty bulled up.
We'd already crunched the numbers here at Bloomberg. We're talking about a third of the plants of the big 5 automakers over in Europe producing at half capacity. How much longer can you keep on doing this? You can't just suspend production forever. At some point, you've got to make a decision about how many plants you actually need, how much capacity you require.
Which is the reason why a lot of urgency is being sounded by a lot of these executives who are coming out and saying we need some sort of framework in terms of how much support we're going to get from the government in order to kind of continue and figure out a plan that actually is viable for the longer term.
Stellantis down this morning by about 1.4%. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Shein is said to be adding more banks to help arrange a potential listing in London. Sources say Barclays and UBS have been picked as book runners for the online fashion retailer's IPO. Bloomberg has learned that the listing could happen as soon as early next year, valuing the company at $65 billion. Qualcomm is likely to wait until after the U.S. election before pursuing an offer to buy Intel. Sources say that Qualcomm wants greater clarity on what types of policies the next administration may bring on in antitrust and China relations. Qualcomm made a prelim approach to Intel on a possible takeover in September. Deliberations are still ongoing, and there's no guarantee that Qualcomm will decide to pursue an offer. And there's a new man for the top job in English football. Former Bayern Munich and Chelsea manager Thomas Tuchel will take the reins of the England national team starting in January. The announcement follows a months-long search after the departure of Gareth Southgate. The 51-year-old has won 11 major honors, including the 2021 Champions League with Chelsea and the Bundesliga title with Bayern in 2023. And that's your brief, John.
Danny, thank you. I don't like it, and I'll tell you why. I think in international football, everyone should be from the same country, don't you? England's done this a few times. Done it with a Italian manager before, Swedish manager as well. I just don't think it's the right approach to international football. Don't you want your manager of your team sort of singing the national anthem with you, hand across his chest and, you know?
Yeah, if they win, do you think people care that much? I mean, if they're really winning, you can get around it. Oh, he's one of us.
You've got to win, of course, yeah.
Learn the lyrics. It's great. So that's basically what I think.
Well, let's see if he can win. Up next on the program, United Airlines taking off.
One of my takeaways, and in general, the way I view the industry is that they're very interdependent, right? So United's pulling a good quarter here, partly because other airlines cut back capacity as well as United.
The latest on the airline industry, up next.
Many global investors that aren't interested in China anymore, but there's a lot that are. And obviously the local investors have money in China and are doubling down on investing in China. Many of the Asian investors, and in fact a lot of the Middle East investors, the Americans are gone away. Therefore, there's an amazing opportunity to put capital to work and get returns which are excess what you would get in other places. Where there is lack of money, there is usually opportunity. So we continue to build out our business in China. It's just where the money's coming from is different. And so we're raising local money in China for investing and bringing those that choose to be there to invest in China. So it's just a different, where the money's coming from is just different.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
This just in from Oxford Economics. In the event of a Donald Trump victory, this is what they've got to say. The upside risk to the baseline GDP forecast during the next presidential term is twice as great as before, primarily because of the tax cuts the former president recently proposed. And as for the tax cuts, Lisa, there are many of them. There are many tax cuts.
I was about to say, which ones? Is it the tax cuts for tips? Is it the tax cuts if you have a house? Is it the tax cuts if you have a child? Is it the tax cuts if you breathe oxygen? I mean, it seems like which tax cuts you're talking about.
The Oprah Winfrey election. Everyone gets a tax cut across the board. That's what the former president is promising. But obviously, I think what Oxford Economics is talking about is 15% corporate tax. The issue is there's nuance to this. Donald Trump says you're only going to get a 15% corporate tax rate if your company is based in the United States, if your products are made in the United States. I have a lot of questions about what that means in terms of what if you have inputs from other countries around the world? What is the threshold for making something in the USA?
It's all Congress dependent as well, as you've said repeatedly too. Under surveillance this morning, United Airlines taken off.
One of my takeaways, and in general the way I view the industry, is that they're very interdependent, right? So United's pulling a good quarter here, partly because other airlines cut back capacity as well as United. And so as long as they're kind of following a similar script and following similar market signals, it'll work out. I think they're all benefiting from slightly lower fuel costs here, which allows them to lower prices without eating into profits, and that can stimulate demand.
So here's the latest. United Airlines authorizing a $1.5 billion share buyback after reporting a beat on third quarter results, signaling the company is recovering from steep ticket discounts that squeezed many carriers through the summer. Stephen Trent of Citi, writing, in light of the near-term interplay between airline supply and demand, the industry's capacity growth moderation is probably not finished. This moderation, continued positive demand and lower interest rates point to a good industry setup into 4Q. Stephen's with us around the table. Stephen, good morning. It's good to see you.
Thanks for having me back.
Let's just focus on the 4Q setup and the setup going into next year as well. From a capacity standpoint, how much has happened over the last few months? How much has been cut?
So you actually have had a lot of industry capacity coming out, primarily from the discount airlines. And when one looks at what's happened post-pandemic, there's been a big structural adjustment, a big wallet shift towards the network airlines, primarily Delta and United, and maybe one or two others. So when we think about the capacity coming out, some of the discount carriers should be flat or maybe even down in 4Q. So the setup actually looks very good for next year if you're on the network side.
Can you just explain why the beneficiaries are United and Delta? Why they're the best setup for what's about to take place ultimately over the next few months?
Yeah, absolutely. So on one level, if you look at what's happened post-pandemic, a lot of consumers are no longer 5 days a week in the office. So that has changed the way consumers behave, including the way consumers purchase tickets. A lot more blended travel now than there used to be. And at the same time that's occurred, we don't have the air traffic control capability. You have aerospace supply chain delays. We don't have the equipment. So given this dearth of new equipment per capita, on a long-term basis, when one thinks about how this is going to affect capacity and unit revenue, If you're a network airline, that's good news. You can put it in the price.
Yeah.
If you're a discount airline that is used to getting high volumes and high block hour utilization, that kind of no longer exists because we don't have...
Can I jump in? Blended travel. I can't let that go. Is blended travel people basically expensing vacations on a work's time? Is that what's happening?
I don't want to put
I'll
it
put it
that
another
way.
way. They're going on a work trip, paid for by their business, the company, and then they're turning it into a vacation on the back end.
Well, you go to a conference someplace Monday through Wednesday, Thursday through Friday, you have something else to do. You're already there, and you're not necessarily in the office 5 days a week. So it's at least conceivable that your employer or your customer is at least partially paying for that trip. And if that's the case, nobody wants a cheap seat. People want a nice seat.
All I can say is Eric Resnick of KSL, he called it bleisure. He said that actually they have a name for it right now, and bleisure is the hot thing that everybody's going to. So I'm sure, John, you'll be doing lots of bleisure, or else you'll be resentful that you're not doing it. Yeah, well, you know.
I'm certainly resentful.
Yeah. He's talking about 100%. you skiing in Davos and me staying on in Puglia for the G7. All right, moving on. I do want to ask, is United's gain potentially all of our pain? Basically, our ticket price is going up.
Yeah, look, so I do think over a long-term basis, the global aerospace supply chain issue is far from resolved. So are we going to have enough fleet, new equipment, as we had pre-pandemic, which allowed for a lot of cheap seating? I kind of think no. I think at least partially that, and possibly folks from lower socioeconomic strata travel less than they used to.
Are airlines just blaming potentially weak demand with the election, like other companies are saying, we're going to wait till we see the outcome of the U.S. election? Or will this actually show up in the data? People don't want to travel during a U.S. election period.
So we're hearing that this is actually already showing up in the booking curve. And I can actually say personally, I actually postponed an international trip because I wanted to be here. And I think a lot of people want to vote. And then they want to snuggle in front of their favorite cable news to see what the heck happens. So people don't want to be out of town for this, I would say. So, you know, that does seem plausible to me.
Do you think that's just the event risk that ultimately just clears? Regardless of who wins, we just get back to business? Or is it outcome dependent?
I don't think it's so much outcome dependent. I think regardless of who wins, and heaven knows how quickly we'll know who wins, I think people get back to business relatively quickly, and we get back to the pace of travel.
Get back to blended business. Stephen Trent at Citi. Love that. Love that. Won't let that go. Didn't know that was a thing. Is that what people are doing?
Yeah, Lizness or bleisure. There was
called?
we had a big
How have I missed
okay,
this?
honestly, yeah,
How
you
have
look
I
at
missed
us.
this?
Yeah, we could have had discussions. We could have
people
helped.
do?
I mean, you could just go for a couple days, You but haven't otherwise, tacked on a day on a nice trip.
People do that here too? At this company?
They actually
shocking.
Oh, God, right? Really?
Shocking.
Are you going to troll us all day? Is that what you're doing?
What if you started, Stephen?
The next report idea, I love it.
Yeah. Coming up on the programme. Up next, with the second hour of Bloomberg Surveillance. These two might not be here anymore. Keith Lerner of Truist, Charles
Snuggle
Myers
with
of Signum
surveillance.
Global Advisors. They're going to blend the business this morning and turn this into a
I know.
vacation. Joe Cassidy of RBC is going to join us, and Gurpreet Garrawal of Goldman Sachs on the outlook for fixed income. All of that and more up next.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
What would you say somebody young who's watching this should do if he or she aspires to be like you?
There's one component of our industry that people need to focus on, and it's not technical, and that's communication skills. Focus on being a phenomenal communicator, invest in that. Think about it, we have to convince a company to sell to us. You just don't walk in and buy the stock or tell them, yeah, you're for sale, I'll pay you this price. That takes years of relationship and effort. Why would somebody sell you that billion-dollar software company growing at 20%? Just because? No way. People hang on to these great assets. And then how do you get on the same page with the executive team of that company, even if they're existing or new? It requires just amazing communication.
If you go to a cocktail party and somebody comes up to you and says, I have $100,000 I'd like to invest, what do you would recommend that person do with $100,000? What do you think is a good idea to do with $100,000 today?
Sometimes they do, and I give them the most boring answer ever. S&P 500.
Just buy an index.
Buy the index. You don't have to worry about the quarterly earnings of a company. Did something change? Did somebody change management? You don't have to make this your full-time job. Just buy the index and you're going to be okay.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have Take-Two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space. That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
It just continues to be a really supportive environment, phenomenal growth, and that is an environment that is particularly supportive for equities.
I don't think that there's anything that you would say, absolutely, I want to stay away from here.
The companies that have been leading the market are the strongest fundamentally.
The financials have done very well this year.
I think the banks are really going to send us off into a more positive 2025.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Lisa would like management to know that blended travel is better for the environment.
Yes, absolutely.
Combining work trips with vacations.
Yeah, you reduce emissions, so why not? I think that it's good.
I'm not going to argue with you.
Yeah,
Second hour of Bloomberg surveillance starts right now, and it's certainly not on that. Equity futures on the S&P 500 look like this. We're just about positive after snapping a two-day winning streak in yesterday's session. We'll get to the chip makers in just a moment. Your day ahead, the week ahead, looks a little something like this later this hour, 7:30 Eastern time. Lisa, we round up and round out the numbers on Wall Street. We get Morgan Stanley.
And so far, the read across Wall Street has been very positive. We've seen beats across the board with net interest income. With Morgan Stanley, twofold. Number one, investment banking. We saw huge beats over at Goldman Sachs, in part because of the competition and working in tandem with private market companies. At the same time, it's really wealth management. How much are they capitalizing on that behemoth platform?
Morgan Stanley up 20% year today. Goldman Sachs up by 35. Banks have been okay in the last 24 hours, with maybe the exception of Citigroup over the last week or so. The chip makers, a very, very different story. Check out ASML. Got absolutely hammered in yesterday's session. It's getting hit again this morning in Dutch trading. We're down by close to 4%. They came out with earnings yesterday on accident, and the numbers weren't good. Big downside surprise.
It came along with orders coming down about half of what people in the market had expected. A big question here. How much is this just a lack of demand for industrial and auto chips? We've seen that with Intel and others. How much is this because of their exposure to China, which is almost half of their sales, especially in light of some of the geopolitical tension?
Well, it's supposed to be half of their sales, and the CFO comes on the call and basically says we see China normalizing, and that's going to be 20% next year. So this is when you look at some of the analyst calls, they're all looking to potentially China. Bernstein coming out and saying there's uncertainty. We have to look at clarification that China demand is expected to normalize. And how much more difficult does that China demand get? Potentially depending on what happens on November 5th.
This story took down NVIDIA in yesterday's session as well. We were down by more than 4%. That's a $160 billion move on NVIDIA. This morning, Lisa, up by, let's call it 0.6% in the pre-market.
I'm so glad you put it that way. $160 billion, and people just sort of shrug it off. Volatility, right? And we've really led to this level of incredible surges and plunges in some of the biggest names, trillion-dollar names. You just have to wonder how much that volatility could potentially spur a larger move. And we've been asking that question repeatedly. So far, it has not.
Trying to find just a little bit of stability this morning. Equity futures just about unchanged on the S&P 500. In the bond market, 4 weeks of yields climbing on a 10-year. This week, we're pulling back just a touch. We're down 2 basis points on the day, 4.01%. Coming up this hour, we'll catch up with Keith Lerner of Truist as chip makers weigh on global equity markets, Charles Maz of Signum Global Advisors as Trump defends tariffs on the campaign trail, and Gerard Cassidy of RBC with Morgan Stanley wrapping up earnings on Wall Street. We begin this hour with stocks looking for a firmer footing as earnings from ASML spook tech investors. The manufacturer of the world's most advanced chip maker machines booking only about half the orders analysts had expected and cutting its guidance for the year ahead. Joining us now to discuss is Keith Lerner of Truist. Keith, welcome to the program, sir. This market was spooked yesterday by that one name and by those earnings. How spooked were you?
Well, first, great to be with you. I don't know that I'm spooked. I think, listen, it was a bad print as far as earnings. But, this market keeps changing narratives. You think about the broader market. One month we're growing too slow. We're heading to a recession for the U.S. Next month, we're growing too strong. And then with the chips, it's kind of similar, right? I mean, about 2 weeks ago, we were talking about Micron, talking about how much demand there was for memory and upgrading their forecast, and the stock's jumping. And then also context-wise, NVIDIA, since early September, that kind of after that sell-off, was up over 30%, semiconductors up over 20%, and then you have this print, and we all know now that ASML's biggest customer is China. So listen, I don't want to be complacent about it, but I'm also trying to put it in context, and I think longer term, especially on the AI side, there's still a lot of demand. Don't forget, maybe one more comment is that, a couple of weeks ago, we were all talking about Elon Musk and Larry Ellison fighting over NVIDIA chips. So again, just some context.
Keith, you're right. NVIDIA themselves have talked about massive demand, and I think you're right to identify China, because speaking to that is LVMH. LVMH earnings, big downside surprise there. Sales not great, particularly in China. So Keith, as people start to get excited about investing in the rest of the world, when you think about where your bias is, and I'm going through some of the details of your positioning, overweight stocks, underweight cash, and you maintain a bias to large caps. Are those large caps in America?
Yes, I mean, we've been Team USA, talked about this on this program for several years now, Jonathan, so we're still there. I will say on the margin, we're still, emerging markets, we moved out of emerging markets completely over the last couple of years, and that's been the right move. Emerging markets have underperformed by about 50%. We upgraded emerging markets one notch here recently, still not overweight, but I will say, I mean, if you look at the rhetoric out of China, I think that they're going to still continue to support that stock market. It got overheated. They don't want it that overheated. So you went up 50%. Now you're down about 15%. I think we're going to get more news, and I think that they will support that market. So on the margin, I think a little bit better. But again, bigger picture, we are still Team USA. I'm just making a reference to a subtle change.
Keith, we were talking earlier about the Bank of America Fund Manager Survey and the 3 pillars that were really supporting the incredible bullishness that has seeped into the market for the past few weeks. One of those prongs was the China stimulus, and yet there's a really concrete question here about how much any kind of stimulus will even trickle into the global market versus just stay in China. How much can that be a pillar of optimism for U.S. stocks?
Well, we didn't need, we haven't needed the growth there for the U.S. markets to be in this great bull market. So I think this recent stimulus is a defense move by the government, but I do think it is the most massive stimulus we've seen since the pandemic. And I will say, I think people are looking for shifts already. Like the stimulus acts with a lag mostly, so I don't think you're going to see it overnight, and I don't think it's going to be this big global stimulus that's going to help Europe to the same extent. I think it's much more focused on stabilizing the local economy, helping the local stock market as well. So I think when people think about the stimulus, I don't think it's the stimulus that we've been accustomed to over the last 2 decades for China and the way that seeps into the rest of the globe.
In the meantime, Keith, we were talking about some of the swings that we've seen overnight, not just in ASML, but also in NVIDIA. And the fact that you're seeing a $160 billion move on any given day, not necessarily on anything related to that specific business, gives a sense of how jumpy and volatile specific names have been. How do you play that, especially if you have a bullish take on it? At what point does it become concerning? At what point is it a buying opportunity for you?
Yeah, so speaking specifically to tech, I mean, we were overweight tech most of the year. We downgraded in June after it got extended, and then in August during the pullback, we added back to it. I would say so. We're still positive on tech. We still don't think we're in an AI bubble. And then with semiconductors specifically, like I said, they had a big move in a short period of time. So we're staying with that primary trend, which we think is up as long as the earnings continue to support, meaning we focus a lot on the forward earning estimates for the broader sector and also the industry. So far, they are still stronger than the overall market. Where we would change our tune is if we see that roll over. We haven't seen it at this point, and I don't think ASML is enough to change it. But again, we'll keep an open mind as we head deep into this earnings season.
This bullishness just hit a bit of a wall in the last 24 hours, and I have to say I've identified a lot of bullishness just around the table from some of the guests we've been speaking to, Lisa. You hear it from Jonathan over at UBS. It's a move to the upside in terms of their outlook, their price targets. This is from the Bank of America Fund Manager Survey. We were sharing it just yesterday on this program. The biggest jump in investor optimism since June 2020 on Fed cuts. The biggest jump in global growth expectations since May 2020. The biggest jump in global equity allocation since June 2020. Keith, this came from Jonathan Krinsky over at BTIG. Fear of downside has left the building, and fear of missing upside is front and center, yet we think now is the time to look tactically at downside risk into month end. Keith, I know it's a very short time horizon, but going into the end of the month and particularly into November, how are you thinking about how to position?
Yeah, so I think time frames really do matter. Like most of our clients aren't trading for the next 2 weeks, but I will say I agree that sentiment is a bit of a risk here short term because markets are all about how things come in relative to expectations. Those expectations have increased. You're also seeing that in like the put to call ratios, which are at the lowest levels since July. I will mention that Global Fund Survey. June of 2020 ultimately wasn't such a bad time to invest. On a short-term basis, you had a 4 or 5% pullback around that period. But again, remember, that was the early stages of a bull market. I'm not saying we're the early stage of this bull market. So I think the way I would think about it is on a short-term basis, maybe a little bit extended, maybe you get at least 1 or 2 more hiccups around the election. But I would think that would be contained within that 5, maybe to 10% max side, and keep focus on the underlying trend, which is positive. I'll also say in an election year, by the way, this is the strongest election year we've seen for the stock market since the 1950s. Normally, if you've been up more than 10% heading into the fourth quarter, you've been up every time. Small sample was only 7 times, so I just want to be clear. So I would just say stick with the primary trend. Then we get some hiccups along the way. I would use that as an opportunity to add.
How much, Keith, does the gain of stocks come on the pain of bonds at a time where there's sort of an inflationary question mark underpinning a lot of this, whether we're in a structurally higher inflation kind of regime? How much are you betting on that in terms of the allocation of stocks really is because bonds look less appealing to you?
Well, bonds have actually acted pretty well this year. They've been acting more like a diversifier. I think for the stock market to do well is really bonds could be stable because what we've seen recently is, our work suggested that, fair values are right around where we are in the 10-year Treasury right now. So I think there's still some value in bonds from a diversification standpoint. There's still decent income there. But, where we would get more concerned is if we started to see yields move back up, say above 450, credit spreads start moving out as well. That would be the concern. But where they are today, I don't think is a major problem. And I still say we still see relative value in the equity market just because if the economy stays more resilient, that should lead to corporate profits continue to move up. And that's been the most stable thing we've seen in this market, right? All the narratives have shifted. The earning trends for corporate America have been the most stable part of this market.
Keith, I have to say there has been a lot of bullishness around this table, and it has been growing over the past few weeks. This from Barry Bannister, just to give a dose of cold water and some contrarian thought over at Stifel, basically saying that the S&P could gain another 10% this year, but then will plunge by some 40% by next year, just simply because As he said, there is a cost to so much winning that basically when you take a look at valuations, they're starting to look pretty heady. At what point do you get concerned just about valuations in and of themselves?
Yeah, listen, I think Barry's a tremendous analyst. I respect his work. We're not in that camp, to be frank. I mean, when we look at, like, say, 10-year rolling returns or 5-year rolling returns, not extreme, maybe more on a short term, somewhat extreme. You know, valuations are a tough thing, right? Because, you know, valuations have changed over time because the tech sector is now, 30% of the market. If you look back to 1990, the S&P tech sector was about 6%, right? And that's where the valuations have really expanded. On the same token, that's where the cash flow and that's where the profit margins are. So in our view, as long as the economy continues to move forward, corporate profits move forward, we can sustain somewhat of higher valuations. I think the way to think about valuations is it likely caps the upside. And in some of our long-term work, we actually think long-term returns are actually below average. On a short-term basis, I think it's really difficult to use valuation to say where the market's going to be, at least in the short term, as far as the next 6 to 12 months.
Keith, would love a final word just on the banks, on the financials going into Morgan Stanley in about 20 minutes' time. What's your take on the earnings season so far? Is this a place you still want to be?
Yeah, you're going to make me look bad in front of a Morgan Stanley print in 20 minutes. I'm just joking. I like the financials. I think the economy is still relatively resilient. Credit seems like it's doing pretty well. They just broke out from a technical level. So we actually like financials along with technology and utilities as our current overweights.
Keith, appreciate it. Keith Lerner of Truist. I've got no knowledge of what those numbers look like, so you may or may not look bad in 15 minutes' time. Keith, thank you. Those numbers are just around the corner. With an update on stories elsewhere this morning, with your Bloomberg Brief, here's Danny Berger. Hey, Danny.
Hey, John. Vice President Kamala Harris is leading in political donations, but former President Donald Trump has picked up some big-name support. Elon Musk has poured $75 million into the super PAC he created earlier this year. Billionaire Miriam Adelson, meanwhile, added $95 million to her super PAC supporting Trump. And venture capitalist Mark Andreessen and Ben Horowitz each donated $2.5 million to pro-Donald Trump super PAC, all of that according to the latest filings with the Federal Election Commission. Qualcomm is likely to wait until after the U.S. election before pursuing an offer to buy Intel. Sources say that Qualcomm wants greater clarity on what type of policies the next administration may bring on in terms of antitrust and China relations. Qualcomm made a prelim approach to Intel on a possible takeover in September. Deliberations are ongoing, and there's no guarantee Qualcomm will decide to pursue an offer. The NFL and Jay-Z are extending their partnership. NFL Commissioner Roger Goodell said that the league will continue to work with Jay-Z's Rock Nation Entertainment Company to produce the Super Bowl halftime show. Early said that Rock Nation and the NFL struck a deal in 2019 to, quote, spearhead and advise on the selection of artists for the NFL's tentpole performances. Rock Nation also helps the league with its Inspire Challenge program, the league's social justice initiative that has given out $375 million in grants. And that's your brief, John.
Danny, thank you. More from Danny in about 30 minutes. Up next on the program, an economic media blitz.
Black families are 40% less likely to be homeowners than others. And that home ownership is one of the surest ways to build intergenerational wealth.
More on that conversation up next on the program, live from New York City. Good morning.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure. Don't miss Bloomberg's interview with the
Live from New York City, welcome to the program. Equities right now on the S&P 500 firmer by almost 0.1%. Under surveillance this morning, an economic media blitz.
To me, the most beautiful word in the dictionary is tariff, and it's my favorite word. It needs a public relations firm to help it, but to me, it's the most beautiful word. We're going to have thousands of companies coming into this country. We're going to grow it like it's never grown before, and we're going to protect them when they come in because we're not going to have somebody undercut them.
So here's the latest. Former President Donald Trump defending tariffs on the campaign trail. Meanwhile, Vice President Kamala Harris ramping up outreach to black male voters.
My agenda is about tapping into the ambitions and the aspirations, knowing that folks want to have an opportunity. If they want, they should have a meaningful opportunity to build wealth, including intergenerational wealth. Black families are 40% less likely to be homeowners than others. And that home ownership is one of the surest ways to build intergenerational wealth.
Tonight, Harris sitting down for her first formal interview with Fox News. Bloomberg's Kelly Lyons joins us now for more. Kelly, let's talk about that key demographic for Democrats. What can she do to regain some of the support that they've lost, not just over the last 4 years, but over the last few decades, to be honest, going all the way back to Barack Obama?
It's an excellent question, John, and you're seeing it borne out in the data that this is a problem area for Democrats. Yes, Kamala Harris now, according to the New York Times and Siena College, has the support of roughly 8 in 10 black voters, up from the 74% Joe Biden had when he left the race. In 2020, Joe Biden got 90% of that vote. So there is still a big gap here in terms of what the turnout for a Democrat, or at least the sentiment around a Democrat, was 4 years ago than to what it is right now. And black men are a big part of that, as we have seen more successful outreach done by the Republican Party toward that key demographic. I was speaking just last week with Quinton James, who runs the Collective PAC. It's a PAC focused on electing black leaders to office and turning out the black vote, who said, look, this is an economic problem at the end of the day. Black men want to be told how the economy will become better for them. So that is kind of how you're seeing Harris really target her course correction here. It is around issues of the economy. She, in that show on Charlemagne the God yesterday, which we just heard a bit of, talked about how reparations that could be paid to black people need to be studied. She also, of course, has put out other policy proposals around small business loans for $1 million loans with forgivable up to $20,000. Also, crypto deregulation and federalizing marijuana, legalizing marijuana on the federal level. Rather, all components of this reach out that she is doing to this very key group.
We also see her tonight with Bret Baier, so clearly she's also going after those potentially more moderate around the country or leaning tactically to the right. How much is the gender gap also impacting the decisions both Kamala Harris and Donald Trump are making in terms of what interviews they decide to do and who they decide to go sit down with?
Yeah, the gender gap is really wide in this election. Women far more likely to be supportive of Harris, and men more likely to be supportive of Donald Trump. So you see that in the media strategies, frankly, of both candidates that we have seen in the last few weeks, including Kamala Harris's interview, not just with Charlemagne yesterday, but Howard Stern's show last week, also trying to expand her outreach to men. And for Donald Trump, he did an all-women town hall that taped yesterday in Georgia with Fox and will air fully at 11 a.m. Eastern time, in which he did have to field questions around reproductive rights, talking about how he sees some states as being too tough on their abortion restrictions, and he thinks in some of those states those restrictions will need to be, quote, redone. And that is part of a softening in the stance around reproductive rights we have seen from the Republican ticket as a whole, not just Donald Trump, but also his running mate, J.D. Vance, who on the debate stage earlier this month said that Republicans need to gain back trust on that issue in particular. And of course, it was during that debate that Donald Trump posted on Truth Social to say he would veto a federal abortion ban. So that's really how he's trying to pull more women back into his corner.
Is there any justification yet, data that shows that that's working, this more nuanced, potentially moderated tone the former president is taking when it comes to reproductive rights?
Voters are still overwhelmingly to say that it is Harris they trust more with reproductive rights in particular, and they're far more likely to say they trust Donald Trump on the issues of the economy and immigration. Those haven't budged much, although we are seeing some movement on the margin. Certainly on the economy, we have seen Harris gaining material ground from where Joe Biden was, and in some more specific issues than just the economy overall, like helping the middle class, she has actually been able to outpace Donald Trump, including in our own polling with Bloomberg and Morning Consult. That said, when you look at polling as a whole, not just on the issues, but about where this race stands, we have seen a material tightening in recent weeks, including on national level polling, which basically shows that this is still a neck-and-neck race, as we knew it would be, but we are well within the margin of error here, and it's getting very, very close in the key states that ultimately could decide this thing.
Kayleigh, we've talked about this extensively. I don't feel like I've got a clear answer on this. We've seen a real momentum shift when we take a look at prediction markets, and certainly, as you mentioned, there is a tightening in the polls. Can you point to anything in particular? Is there a particular issue or a particular region that seems to be leading that?
I don't know that there's a particular issue necessarily, Lisa, but something I've been discussing with strategists, frankly, on both sides of the aisle in recent days is that there haven't been many clear catalysts. If we consider just Kamala Harris's campaign specifically, which of course launched something like a rocket ship, frankly, once Joe Biden left the race in terms of fundraising, in terms of how immediately she was able to jump where Joe Biden was at the polls. She had her candidacy launch, followed shortly thereafter by the selection of her vice president. Shortly thereafter that, of course, the Democratic National Convention in Chicago. After that, a debate against Donald Trump. That was back in September. Since then, there hasn't been any kind of big catalyzing event like that. So that could be a factor here, certainly, as we are not likely to see another debate between these two candidates. And so they're forced to grab their own media attention, if you will. And that's why we're seeing them picking up the pace of interviews on a variety of different platforms and mediums in recent weeks.
You mentioned with Donald Trump a real question around reproductive rights and his appeal to women. What specific issues are you looking to hear from Kamala Harris in her interview tonight on Fox?
Well, I'm sure she's going to be pressed on her weaknesses, which, as I mentioned, are immigration and the border. She could face questions around what we have seen consistently from Republicans. Why have these issues not been fixed as she's been vice president for the last almost 4 years? It's going to be interesting to see how she tries to center herself in this interview, operating under the understanding that she's appearing on Fox for a reason, as she's trying to reach out to, say, those Nikki Haley voters, people like Liz Cheney, who do identify as Republicans but do not want to support Donald Trump in this election. So in many of these ideas, she's going to have to moderate herself. Those are the kinds of difficulties she's going to face in this questioning, as she has not appeared on Fox yet in this election cycle. And of course, this is an audience that is not as friendly to her as some of the other networks on which she has appeared of late.
Kayleigh, appreciate the update. As always, Kayleigh Lyons there. Down in the nation's capital in Washington, D.C., as Kamala Harris, the vice president, tries to do something about the black male vote, which has been weakening ever since 2008. You have to go back several election cycles, which makes the comments from the former President Barack Obama even more odd last week, to lean into the issue, to make it sound like the bigger problem here was the prospect of misogyny, that individuals didn't want to vote for Kamala Harris because, quite simply, she's a woman. I'm sure you can find examples of that. But overwhelmingly, if you go back several election cycles, the biggest pushback to that by some measures, Hillary Clinton got more of that vote than Joe Biden did.
It's unfair to blame it on Kamala Harris being a woman, because actually it's the Democratic Party losing black men ages 18 to 45 since 2008.
It's a problem, and it's been a problem that's building for a while for that party. Coming up on this program, Jared Cassidy of RBC, results from Morgan Stanley. Coming up next, that stock is up 1%.
countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Live from New York City, welcome to the program. Equity futures on the S&P 500 just a little bit higher. On the S&P right now, up by about 1/10%. On the Nasdaq, up by 0.2. One name in focus, Morgan Stanley. Morgan Stanley, up in the pre-market by 3%. I'll make it simple, one word, beat. A few more words, beat, beat, beat. This is what it looks like. Third quarter wealth management revenue, $7.27 billion. The estimate, 6.88. Equity trading, beat. Fixed sales and trading, beat. Investment banking, beat. Gonna make it easy, Shanali. Where did they miss over at Morgan Stanley?
You have to look through the finer tooth details. There's only a little bit of a miss there in the equities underwriting, but they can get a big pass here because not only is it a clean read, it's a soaring read. And this is an environment that's a real sweet spot for Morgan Stanley. Wealth management revenues coming in not only above expectations, but those pre-tax margins handily beating. That is something the street watches very closely. You also have equities trading coming in well above expectations, fixed income trading as well. Equities now is interesting because even though the number beat expectations, it came in a little lighter than Goldman Sachs. That competition has been really stunning to watch on Wall Street, and will be interesting to see what the CEO says about how competitive they want to get, because it's a matter of how much risk they want to take on in these markets at record highs. Very little to look down on here. The expense efficiency ratio is better than expected and better than it was a year ago. So they're making more by keeping a handle on costs as well.
Yeah, well, they're talking about having more assets under management, more revenues from wealth management as well. One interesting theme that we've seen from all the banks, and this is the final of all of the big ones to report, is an increase in provisions for credit losses that's being viewed as a bullish thing, that they actually want to take on more risk, not as a bearish thing that they're anticipating an increasing number of delinquencies and defaults. Can you explain that?
Yeah, it means that people want to be extending credit here at this part of the cycle. And you can see it not just for the consumer, but for the corporate clients here, for all the big banks. Debt underwriting, just stunning at every one of these banks. But I also have to say, you have to wonder if that sentiment about not worrying about provisions will last through the regional banking cycle as well, because these clients tend to be wealthier. We talk about those FICO scores at Bank of America. Even at Citigroup, they're generally above 660. So once you start to get into kind of the players that are in the riskier parts of the market, that's when the sentiment starts to be questioned a little more.
I will just say PNC and U.S. Bancorp both have reported earnings and both beat expectations as well across the board. So some of the lower tier or smaller banks, those are the top tier of the smaller banks, have also beat estimates. When you take a step back, can we still say that Morgan Stanley and Goldman Sachs truly are neck and neck in the way that they used to be? Or are they different banks with different profiles that have different goals at this point in the cycle?
I think the market is telling you they're different banks. And the reason why is, if you can imagine, before we headed into these earnings, Morgan Stanley this morning was actually trading at a higher price to book than JP Morgan. What is going on there? People really, really love Morgan Stanley at this part of the cycle. And I think it's because you saw about a year ago, they finished integrating the rest of their wealth businesses. They headed down towards the stack when you think about the wealthy clients they've taken on, and more mass affluent as well. What can they do? What I'm understanding about Morgan Stanley is they're trying to lean into that wealth management business to also drive more investment banking revenue. Now, if they can catch up to a greater degree to Goldman Sachs to that investment banking revenue, game on.
Stock is up by almost 3% this morning after rallying 20% through yesterday. You're catching up with Ted Pick a little bit later. Is he putting his stamp on this company now, on this bank? Is he getting out of the shadow of James Gorman?
You know, it took a couple months, but that's kind of nothing, isn't it, after James Gorman's legacy? And you do see these numbers coming in super strong. It's no surprise that he wants to talk today, right? And so, you know, some questions I have are around how sustainable this is. These are really good numbers. And at the end of the day, we are looking at hedge funds sitting at near record leverage. Can they keep doing that to drive this market higher?
Looking forward to this conversation a little bit later, 10:30 Eastern Time. Sonali Basak sitting down with Morgan Stanley's Ted Pick. Joining us now, Gerard Cassidy of RBC. Gerard, that wraps up the earnings on Wall Street. Let's sit on Morgan Stanley just for a few beats. A number of beats from that name, a few upside surprises. Gerard, what do you make of what's behind these gains from the likes of Morgan Stanley, from Goldman? Are they durable? Do you expect these tailwinds to stay with these companies into 2025?
I think so, John, because when you take a look at some of the lines for these companies, in particular the ECM business as well as the advisory business, as David Solomon from Goldman Sachs yesterday pointed out, that we are still below the 10-year averages, and so particularly in IPOs. So if the Fed is truly going to continue to ease and cut rates between now and the end of next year, we're in the soft landing, as I think you guys know. This sets up very well for the investment banking business, especially, again, on the IPO business and possibly in the mergers and acquisitions. Higher rates had really kind of put a little cold towel on that, as well as regulatory concerns out of Washington, but lower rates should help the mergers and acquisition market in 2025.
Gerard, what do you make of the increase in revenue that we see from trading as well as banking at a time where a lot of people said that is an area that needs to reignite? You were talking about the regulatory regime, in particular, some of the dampened IPO activity. How can we understand then the incredible beats that we've seen across the board?
I think part of it is that when you take a look at the trend lines, you know, from 2020 and 2021 have been generally lower, as you know, particularly in 2023, and things are starting to come back. And on top of that, the amount of liquidity in the markets is phenomenal. When you think back to what the Federal Reserve did during the pandemic, they took their balance sheet to $9 trillion. They've brought it down now to just over $7 trillion, but that's well above where we were pre-pandemic, around $3 to $4 trillion. So there's plenty of liquidity out there. Asset values are going up. And as a result, you're seeing it in the trading numbers, both in fixed income and equities. The investment banks pointed out that after the Fed funds rate cut, they really saw a pickup in DCM activity, which then led to probably better FIC activity as well.
You know, I have to say, Gerard, Sonali mentioned this point earlier. This is the big banks, but not necessarily the smaller regional banks. And I do wonder how much we're also seeing the outperformance in smaller banks, in regionals. Gerard, from your perspective, are you seeing better than expected performance, the likes of PNC and U.S. banks, as really highlighting what a different scenario we're in right now?
We did see better than expected numbers there for both those banks, as you pointed out, and you were going to see a slew of regional bank reports over the next 2 or 3 days and into next week. And we do expect to see a continued better than expected performance. And the real key is going to come as the Fed continues to lower short-term interest rates. As you know, funding costs are going to come down. Funding costs went up meaningfully as rates went from 0 to 25 basis points to over 500 basis points from the beginning of 22 through the middle of 23. Now, asset yields will come down, as you know, but they're not going to come down, we don't believe, as fast as funding costs. So the regional banks, which rely on net interest income to a greater extent than the diversified banks, should do quite well in this environment over the next 12 months.
Gerard, shouldn't that also benefit Bank of America? And I'm going to raise a very dangerous question because I don't know the answer to this, and I imagine you don't either. What's Warren Buffett actually up to, selling down a stock into an environment that the stock should do well in?
John, it's an interesting comment because, you know, Buffett has made an enormous amount of money when you think about when he put that first investment in, I think it was back in 2011. So But when you think about how much he has made from that period to where we are today, if you look out over the next 2 to 3 years, will he make that kind of return? Probably not, because he got in at such a low cost basis back in 2011. So I just wonder if it's good old-fashioned profit taking. Obviously, we don't have a call into him. They don't disclose why they sell stocks, but you have to wonder if that's that's the reason for the sales.
Yesterday, we heard CEOs talk about strength when it comes to the U.S. banks. Today, Ted Pick, in his message to shareholders, the first adjective he's using is strong. Was there any weakness that you're seeing in any of these big banks?
I would say the short answer is no. There is still the concern of commercial real estate office, so we should not overlook that. Now, when you think about that area in particular, from the end of the pandemic to today, the deterioration has been meaningful and noticeable. The good news is that the urban office markets are not, the banks don't have overexposure there, particularly the smaller regional banks. So we're not out of the woods in that area. So that would be the one area that we would continue to monitor and watch. The banks have taken their medicine. Many of them have reserves to those office commercial real estate portfolios that exceed 10% in credit losses, which is very meaningful. But that would be the area we're in the early innings of working that problem out. It'll last probably another at least 2 to 3 years. But again, we think it's very manageable.
Gerard, I have to say there's always a spectrum when you listen to bank earnings of fear as well as greed. And right now, with the increase in credit provisions, you have to think at this moment, based on some of the commentary around that credit provision build, this is more, I don't want to say greed, but more the desire for bigger returns, more the desire to lend. How much is this a signal that credit is actually going to loosen up dramatically? That in terms of easy financial conditions that people describe in capital markets, that's going to trickle into consumer loans and a whole host of other types of lending activities?
Lisa, I think you're onto something, because two things have happened. First, if you look at the senior loan officer survey, back in 2022, when rates were moving up very rapidly, everybody was expecting recession in 2023, and the banks tightened up their lending standards. They built up their loan loss reserves in anticipation of a recession, which obviously never showed up. But also, you might remember Basel III Endgame. That proposal came out in July of 23. That was going to require banks to carry much more capital. You might remember the expression risk-weighted asset diets that even JP Morgan had talked about last year in the second half of 23. So now with the new Basel III Endgame that hopefully we'll get the numbers by the end of this year, the expectation is a much lower capital increase. So the banks have plenty of room to lend. They see the economy looking better. So I think the surprise next year, to your point, is that we could see better lending, particularly in commercial and industrial lending, as companies start to build out inventories, take on capital expenditures, and the commercial banks will be beneficiaries of this.
Interesting. Gerard, appreciate your contribution, as always, to earnings season. Gerard Cassidy there of RBC. On the big banks on Wall Street, as Morgan Stanley rounds things out, that stock is up in the pre-market by 1.6%. Let's squeeze in a few more news stories. Under surveillance this morning, the US has a new warning for Israel. The Biden administration saying it may withhold weapons to the country if the humanitarian situation in Gaza does not improve. A letter to Israel's defense minister calling for a minimum of 350 trucks of aid into the Gaza Strip per day.
What's interesting about this is, one, we heard from one Pentagon spokesperson who said we didn't mean for this letter to get out. So clearly they didn't want the world to know about what was going on in terms of basically this idea that potentially what they're insinuating is they may withhold some weapons if Israel doesn't get that aid through. Also, they said they have 30 days. That brings us to after the U.S. election. My view on what this Biden administration has been doing in terms of how they have this almost carrot and stick approach when it comes to Israel and potentially other foreign policy issues is it feels like they're just treading water to get over November 5th.
Which really is the reason why, and actually we've been discussing this in this show, this question of how perilous the next couple of months will be from a geopolitical standpoint, because there is this perceived vacuum of leadership in between the election and whoever takes office in January.
We still really don't know how Israel's going to respond to what has been an unprecedented attack from Iran. Not too long ago, these were red lines that if Iran crossed, this was a big, big deal. It's still a big deal. We're waiting for retaliation.
What this past year has told me is that constantly red lines have evaporated in front of our eyes. Not just one Iranian attack on Israel, a bombardment of missiles, but two. April, most recently, a few weeks ago, also the THAAD being sent over to Israel. That has never happened before. So we are really in almost a whole new fragmented geopolitical world just in the Middle East itself.
That region has changed a lot in the last 12 months. That's the latest from the Middle East. Here's the latest in the airline business. United Airlines beating Wall Street's profit expectations for the third quarter. The company also authorizing a new $1.5 billion share buyback. More airline earnings ahead this month, including American, Southwest and JetBlue. We caught up with Citi earlier this morning. Some of these airlines, not these airlines, have reduced a lot of capacity. And these airlines are going to be the ones that ultimately win out because of it.
And essentially, to me, basically, read between the lines, prices are going up again. I mean, essentially, airplane prices are going to go up for people who can afford to fly, and those who can't probably aren't going to fly, and that's why you're going to see the lower income airlines not do so well, because essentially, what you've heard from all these airlines is that the glut and the pressures from competition have been alleviated, which basically means expect to pay more.
I thought it was just an excuse that airlines were saying they're going to lose some demand because of the U.S. presidential election. People want to stay home. But Citi's saying actually they see it in the booking curve. And even our Citi analyst is telling us, I'm foregoing an international trip because I want to be in the United States to vote and snuggle up to his term watching the news and the press.
Less blended vacations, apparently. Blended trips.
Yeah.
Work, vacation.
Leisure. What is your aversion to it? Okay, honestly,
I just wasn't aware that it was a thing. And then you both told me that you've been doing it for so long, and I didn't know.
Oh, really? Keep going with this. This is great.
I didn't know about this. Let's talk about chips. You want to talk about chips? We should talk about chips.
Chips or trips?
Chips. Chips and trips. Global chip stocks under pressure. A tepid outlook from the key equipment supplier ASML, sparking a sector-wide rout as the company cut its outlook on areas beyond AI. Market jitters extended to NVIDIA shares. They fell nearly 5% on Tuesday after reaching a record close just earlier this week. Lisa, I think you break it down really well. There's something happening beyond AI that may not touch the likes of NVIDIA. It might impact other companies. And then you've got this big piece of the puzzle. It's China. And LVMH spoke to the weakness in China.
And it's very difficult for people to really parse through this. We've seen this with Intel, right? I mean, they are more exposed to the industrial and automotive sectors that buy chips, and you haven't seen a real revival in that sector. On the flip side, if you have a company with such a dominant market share coming from China, how much are they going to be permanently and structurally challenged as a result of some of the fissures geopolitically between China's tech world and, frankly, everything else and the rest of the world?
ASML, the main listing over in Amsterdam, the Netherlands, that stock is down, recovering just a little bit, still lower by 2.9%. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. Airbus plans to cut as many as 2,500 jobs at its defense and space division. Sources tell Bloomberg the plane maker is attempting to streamline a business that's been racking up charges and suffering from competition. The people familiar say that Airbus is still evaluating options on just how to downsize that business and is in discussions with the unions about those job cuts. Adidas has raised its profit target for the third consecutive quarter thanks to a boom in demand for its retro sneakers. It now expects operating profits of $1.3 billion. But as you can see, shares of Adidas are lower in the German trade by about 3%. Investors expected the company to raise guidance after its recent outperformance, especially when compared with its rival Nike. Shares, though, are up nearly 27% year to date. Tom Brady has been approved by the NFL to buy a stake in the Las Vegas Raiders. Brady, along with Knighthead Capital Management co-founder Tom Wagner, are buying a 10% stake in the team. The former star quarterback is the only broadcaster who is a part owner of an NFL club. The league, though, placed strict restrictions on Brady. He isn't permitted to attend in-person or online production meetings. He can't have access to team facilities, places, or coaches. He also can't criticize officials or other clubs. And that's your brief, John.
Apart from that, he can do what he wants. What's that about?
Yeah, I don't know. It's just basically a money thing rather than an influence thing, I guess.
Sounds boring.
Danny, thank you. More from Danny in about 30 minutes. Up next on the program, staying vigilant.
We have to be really focused on fully delivering on 2% inflation while ensuring that the labor market remains in line with full employment.
That conversation up next.
top names in business are on Bloomberg.
The challenge for us now is not very much on the product. It's on the ramp-up of the production system.
We turned the industry down to almost zero during the pandemic. And what we're trying to do now is turn it all the way back on. And that's hard. We lost not only people during the pandemic, we lost a tremendous amount of experience.
A lot of skilled people have left the industry. We have to hire new people. The supply chain has to hire new resources and train the people, educate them.
And because those roles are filled now not by a 58-year-old, but perhaps by a 28-year-old, there's a lot we have to do in terms of not only adding capacity, but capability to meet the ramp that we all are embarked upon.
We have thousands of suppliers, and when you have just a couple of them, few of them that are late on the ramp-up, well, that's slowing down everybody, and that's what we've been facing earlier this year.
Nobody covers business like Bloomberg. Context changes everything. From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
As we spend some time here on the broader presidential race,
let's focus in on European politics.
Makes you wonder how politics might play out